So this is something that could weigh on Novo at the start of trade. And keep an eye on Orsted. Again, this is US action there around offshore wind projects, as Joe was mentioning. Guy.
So single stocks are going to have an impact this Tuesday morning, which I think is interesting. In a world that's been so macro-driven of late, we're beginning to fold that narrative back in. We'll look for Tesla a little bit later. SAP out with numbers too. So here we go. The opening trade Tuesday, the FTSE's a little negative, but not that negative, which I think is interesting. The IBEX is down by 7/8 So some more negativity there. So some quite interesting dispersion beginning to be priced in, and that takes you back to this kind of difference between the market complexion of these various bourses around Europe. So the stock 600 in aggregate down by around 0.3%. Some of these single stock names will have an impact. They are heavyweights. They are going to make their presence felt. The CAC 40 actually opening fairly flat this morning. We'll see what L'Oreal does as well. So that's a reasonably positive trade that we need to fold in as well. Think as well about what is happening with currency markets here too. You've got a 115 handle on euro dollar at the moment. Cable trading 134. The translation effect in some of these single stocks is also quite interesting and in aggregate for the market too. So that's the picture. We wait for the DAX. We'll see what happens there. We'll wait for the SMI. There's going to be an interesting roast trade as well, potentially as well this morning to factor in. Lizzie, what's happening with the sector story?
At the moment, you've got consumer products and services at the top of the baskets. That's up 0.7%, and that perhaps reflects, as you were saying, the L'Oreal story. That's up 2.2% off the back of those numbers on Thursday. More demand for pricey perfume and makeup. So that is going to perhaps boost Paris when we have those numbers. But sectorally, about just under half of sectors in positive territory. Bottom of the basket, though, construction and manufacturing, that's down 0.9%. Energy not far behind, and tech not far behind that, which is interesting given that stateside you're seeing NASDAQ futures pointing higher, even though we're awaiting those results from Tesla as well. Right,
yes, we're getting a different dynamic as the further you look ahead into the US session, you get a more positive sense of risk appetite. Interesting that we're not seeing a bigger rise in L'Oreal, perhaps, given what the ADRs did, given some of the calls that we saw earlier on. The trade on TradeGate was much more positive than just a couple of percent up. Oh, now it's, yes, a couple of percent up. So, you know, that's interesting in itself, perhaps. Interesting that autos and auto parts are rising. We've got quite a few ex-divs across the market, but some of them come in that sector. And the likes of Stellantis and Ferrari trading quite a bit higher when you factor in that they are ex-dividend. So that's an interesting dynamic.
Nestle ex-dividend, which is interesting, going into that story. But going into the numbers, SAP is the biggest point drag this morning, ahead of the numbers which are going to come out later on this evening. I think it's the biggest technology stock. I think it is probably the biggest stock potentially in Europe at the moment. So it's interesting to see that you are seeing some weakness creeping in there. ASML is also weakening as well. But there is the kind of the Nestle ex-div trade, which I think you just need to be aware of this morning.
Yeah, I would have mentioned UniCredit, but that is also ex-div. Those down 3.7%. But interesting that UniCredit is saying that it can't yet decide on the BPM deal, given that the Italy conditions at the moment. And we're still waiting for Novo to open as well after that Lilly news that Joe Easton mentioned. So as we wait for things to get going, let's speak now to Haig Bathgate, CEO of multifamily office Callanish Capital, who I'm pleased to say joins us around the table this morning. Haig, I want to start big picture. I was scrolling through your LinkedIn over the Easter holiday, and there was this post where you said that anyone who wants to understand Donald Trump needs to read The Art of the Deal, right? And you were saying, you know, his style is to deliver the goods. Do you really think that his tariff policy is about returning manufacturing to the US? I mean, is it actually just about... I was thinking a lot about this over the weekend. Is it really just about weaponizing uncertainty?
Yeah, I think so. I think the problem is the risks are so large this time round because you're not talking about a construction project or something. You're talking about the sort of Western world running order. So I think a lot of... If actually you take the politics out of it, and I'm completely non-partisan on this, actually what he's trying to do in terms of addressing the deficit is a good thing, and you saw Musk actually talking about this a couple of weeks ago. The problem is he's trying to do it at breakneck speed, and you can't relocate, you know, TSMC manufacturing on sort of that level of detailed manufacturing type specialism to the US overnight, and I think that's where the whole thing's coming unstuck. And now, of course, we're starting to see if there's any negative impact from the economic fallout of tariffs. It's going to be blamed on the Fed and Jerome Powell.
Well, yeah, on that point, I mean, there's this saying that markets are the guardrails, you know, and if there's this question of Fed independence and that credibility, can they be the guardrails on Donald Trump?
Yeah, well, look, I think what we're seeing with the tariff talk will be the same thing that we'll see with the Fed now. He'll push, then he'll moved back a bit, then he pushes again and moves back. And of course, we saw this at the start of his first term, not to the same extent, but he went in very hard initially, and then he backs off because obviously he wants to get the economic growth coming through. So I think that's what we'll continue to see, but unfortunately it's very, very volatile for markets.
Haig, I just want to play a bit of sound. Our team has been talking to LTCM founder Victor Hergani about the idea of safe assets. Let's just have a listen.
Learning finance at university, it's like, oh, the risk-free asset. We're always hearing about the risk-free asset. There is no risk-free asset. U.S. treasuries are not risk-free. For one thing...
Is that new information? There is no safe asset? I mean, should we always have known that? But we did colloquially refer to treasuries as the risk-free asset, and everything prices off them.
Yeah, I think so. I think at the moment the US again is in the spotlight, and if the operations of the Federal Reserve is going to be called into question, then clearly it's not a safe haven asset. But European bond markets look pretty robust at the moment. If you buy German government bonds, I think they're going to be fine. You're probably going to see inflation trending down as well, not for good reasons, but ultimately there are safe haven assets that you can still park your money in. Gold, obviously, the inverse trade of the dollar, which I think are inextricably linked. So there are still safe assets, I think, that you can.
Okay, so there is such thing as a safe asset,
Yes.
just not necessarily where you thought it was.
Yes.
Tell us more about your view on gold, then. I mean, gold prices, where are we now? $3,472 a troy ounce, went over 3,500. It wasn't that long ago we were talking about whether it would go over 3,000. Goldman Sachs now asking, will it go over 4,000, or has a call suggesting it could. What stops it? Anything?
Yeah, well, it's got a lot of momentum, doesn't it? Which is positive. So you're going to have a lot of the sort of platform funds trading it and pushing that momentum higher. Ultimately, it's the inverse trade of the US dollar, and it's quite a cheap way to play dollar weakness because you don't have the negative carry when you own gold. So I think as long as this sort of kind of pantomime continues in the US with the Federal Reserve, you will see gold move higher.
Pantomime. How do I invest in a pantomime? In all seriousness, what am I doing? How are you approaching this? What's your framework right now for thinking about the pantomime?
Yeah, well, the problem is pantomimes are incredibly expensive in bid-offer spreads. So
that's often how I think about pantomimes.
Financial pantomimes, anyway.
Yeah.
So, I think you just have to let the dust settle and just try and work out what the end game is.
Do I stay invested in that process?
Yeah, so we were staying invested. I mean, look, the good thing is, other than in the US, I mean, again, a lot of commentators will obviously position themselves from the US. But look, in Europe, we now have the negative relationship between bond prices and stock markets. So we have that whole 60-40 thing that wasn't working 2 years ago is now working again in Europe. So, we're using a lot of European government bonds. We actually like them because I think the inflation framework starts to reduce, and you are getting that natural hedge without having to bet the shop on one outcome.
So for European investors, the picture is clear. Is that how US investors, do you think, will ultimately react as well? Do you think they will look to Europe for that ability to put that trade on, that more balanced sort of either side of the boat trade?
Yeah, well, look, I think a lot of US investors would only ever consider the US bond market, but obviously now it's a dangerous place to be. I mean, obviously, if things get out of control too much in the US, what we'll see is yield curve control. I mean, that'll be the next thing, and there will be if the markets become so dysfunctional.
How realistic is that?
I think it's absolutely realistic. I mean, look, we saw that a couple of years ago when we had the Truss government. So if they need to exercise control because it's going to lead to dysfunctional markets, then absolutely, I think they'll come in and use yield control again.
Can you give me some optimism, Haig? I know you've been looking at potentially services as a way out of the great lock-on tariffs. What are you hoping for?
You're thinking that's optimistic. Let's see if that's optimistic.
Yeah.
There we are, Haig. Is that an optimistic story?
Yeah, look, I think what the markets can't deal with uncertainty. As soon as we get any degree of certainty, people will position themselves accordingly. I think with Trump, the bark is always worse than the bite, even though we're seeing this sort of extreme of that at the moment. And look, ultimately, this is his legacy, I would imagine. So as he gets towards the end of his term, he'll want these things to be turning round. So I'm not suicidally pessimistic, and we're remaining fully invested on the equity side of things.
That feels like a long way away. Like the end of the Trump term, assuming that there is an end to the Trump term.
We're almost 6 months in already.
Feels like longer. Hey.
We've all aged.
Yeah.
Makeup's doing a lot of work.
Hey, nice to see you. Thank you very much for stopping by to see us. Hey, Bathgate, CEO of Multifamily Office at Callanish Capital. Let's talk about where we are with the Core 6 and try and understand what is happening here. We are looking at a market that actually is seeing quite significant dispersion. Ignore the right-hand side of the board. Focus on the left-hand side of the board. What is happening with Novo Nordisk is quite eye-watering this morning. Nestlé's gone ex-dividend, but certainly you're seeing some weakness in tech as well this morning. Luxury's doing all right. LVMH is just down a little bit. L'Oreal's having a slightly better day. Joe Easton, what's going on?
So that is the really big move of the morning, guy. Novo Nordisk down now. We're down 8% over in Copenhagen. Now, remember, this stock hasn't traded since Wednesday because the Danes enjoyed a nice long 5-day break for the Easter period. But Lilly announcing that data on a obesity pill drug that saw users lose around 7% of their body weight in a 40-week period. And clearly a pill is going to be preferable over an injection, which is normally the device used by Novo Nordisk drugs, including Wegovy and Ozempic. So therefore, the competition risk hitting Novo Nordisk really hard in trading this morning, by far the biggest points decliner on the stock 600 in early trading. Then we've got the wind stocks, big moves over here, particularly in Ørsted. Now, Trump putting a halt on a massive project, a wind project run by Equinor, constructed by Equinor in New York. But that is seen as a negative read-through for Ørsted as well, which also has projects over there. And we've seen analysts, Bank of America, Barclays, already downgrading to underperform or sell on that stock this morning. So really big moves in those shares. Again, that stock Ørsted not traded since Wednesday. So pricing in all of that negativity. Then in terms of L'Oreal, coming up a little bit, but as Anna said earlier, not as much as perhaps we had expected or seen in the ADR, but we did see pretty decent sales in the European market and also in Asia. So that one actually coming up a bit. It was weak, of course, after the LVMH report recently, so potentially just pairing a bit of that. Then we've got the gold miners. Another good day for these as gold once again hits a new record high, rising to around $3,500 an ounce. It is up around 100% over the past year or so in terms of the gold price. So Fresnillo, Endeavour in London and Greatland Gold, all three of the London-listed gold miners rising today following that news, so a decent one there. And then in terms of electrification, now Amazon said to be the latest company scaling back its data center rollout. That's according to a report by Wells Fargo. An analyst at Wells Fargo said that that is what he is seeing in those trends, and that does seem to be feeding through into these electrification stocks. Schneider, Prysmian, Legrand, Siemens Energy, all weaker following that report from Wells Fargo. We did, of course, see worries about Microsoft doing the same thing, hitting that sector recently, and it's now Amazon weighing on the sector today. And then finally, just finishing on UniCredit and Banco BPM. Now, UniCredit is saying that it's not able to fully push through with its takeover of BAMI, Banco BPM, until it is able to digest the conditions set by the Italian government. They say that the conditions that have been imposed are really hard to digest, and they're waiting to see whether they can progress. But at the moment, that does seem to be weighing on those stocks. BPM down 1.9% and UniCredit slipping as well in Italian trading.
Joe, thank you. Joe Easton from our equities team. Coming up on the programme, Tesla reports later today, and investors will be keeping a keen eye on performance and Elon Musk's plans to ease concerns over his external activities. That sounds euphemistic, but he's obviously very close to the Trump administration, and that has not gone down with some consumers, in particular here in Europe, but that's a bigger story. We'll talk about that and all the other details to watch out for when it comes to Tesla. We will have that for you next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Back to the opening trade. We're coming up to 17 minutes into today's session, and you're looking at European equities playing catch-up to yesterday's session on Wall Street after the Easter break. You've got to process all of these tariff threats and the lack of progress on tariffs, and also Donald Trump's threats to Fed independence. So the FTSE 100 pretty flat at the moment, but the CAC and the DAX both down more than 0.5%, even if Wall Street futures are pointing to a more positive start stateside this morning, Guy.
So the Danes have had even longer off, and therefore the Copenhagen market this morning is having an even bigger issue, particularly with this stock, Novo. So Novo's this morning trading at 392, Novo Nordisk. The high was 1,028. The low, which was hit back in 2020 over the last 5 years, is 200. This stock is down circa 60% from its highs, and the latest hit basically comes as its big rival Eli Lilly has got a pill that is going to deliver the sort of the GLP-1 technology to people, and is obviously a significant rival to Novo's Ozempic. So what happens next, and how big a problem does Novo actually have? We need to talk about Roche. We'll come and do that in just a moment. But let's get a take, first of all, on Novo from Bloomberg Intelligence's senior pharma analyst, Sam Fazeli. Sam, great to catch up with you. How big a problem does Novo have here? Lilly's stock is barely off its highs. Novo's is down really sharply.
Yeah, so Guy, good morning to everybody. The issue with Novo versus Lilly is that Lilly is more than just obesity, but of course the majority of the moves these days have been driven by obesity. And Novo's got an issue here in that not only it has got a serious competitor in Lilly, even the injectable drugs that they have, Zepbound is better, Lilly's drug is better than Novo Nordisk's in terms of the efficacy profile, etc. Now, Lilly has an oral drug, a truly oral drug, not a reformulated version of the same injectable, that might be able to manufacture more cheaply at a higher volume. All that is supposed to be, still needs to be worked out. That gives you similar efficacy, and we don't know much about the side effect profile, but it sounds like it was relatively benign, or at least no worse than what we were already getting with the injectables. So this is an issue, and you know, the company doesn't have an oral drug, apart from obviously reformulated Wegovy or Zepbound or semaglutide.
Yeah. Sam, lingering on this theme for a moment, Novo Nordisk now sliding to become Europe's 5th biggest company by market cap. So another illustration how it's off its highs. And Guy was talking about just how far this has fallen, because as he said, it was above 1,000. This is the share price, was above 1,000 Danish kroner. It's now at 393. We haven't had prices like that on Novo since 2022. I mean, we're almost going back to pre-Ozempic times when we look at the price of this. Does this throw up opportunities at all?
I mean, look, Novo's been one of those stocks that many analysts have looked at valuation and thought, it's time to call a sell. And they've all been wrong along the way, right? I'm talking over the past 20, 25 years, having been watching this stock. So there's something that one mustn't forget. The potential size of this market is massive, right, in the obesity and diabetes market. So that hasn't been taken away from them. And the ability to fill prescriptions for all those patients around the globe is not necessarily, is not that easy, as we've seen. The other element that, of course, we have to figure out, one positive, one negative. The positive could be they're going to be the first ones to have a Alzheimer readout for the same class of drugs this year, potentially. That could be a big upside if it works. The negative is that they are based in Denmark, and there's this still lingering, I don't know how lingering it is these days, argument about Greenland, the US, and Denmark, and maybe that's an additional pressure on them. I don't know how relevant that is these days.
Well, Sam, you bring me on to Donald Trump, because I want to talk about Roche. You've had this announcement that they're going to invest $50 billion in pharma and diagnostics in the US. Isn't that exactly what Trumponomics wants? Is it that we're going to see more of these moves in the pharma space?
Yeah. I mean, I'm going to invest $1 billion in my home here for the next 5 years. I mean, who knows, right? The announcements are cheap. What really needs to happen is, which I'm convinced that the companies are sincere. The question is, of the 4 companies that I've run, and listen, let's not forget, they're the 4th one now. The other Swiss pharma company, Novartis, pledged $23 billion. Lilly has pledged 27, and Johnson & Johnson, $55 billion. Now, these are interestingly all over the space of 4 to 5 years. What happens in 4 to 5 years? Another election. So where this money goes, when this money goes, some of the companies have said they've already broken ground. Most of them, I think, are going to be saying, well, we'll see how this all goes, gets spent. But, the number of jobs involved doesn't seem massive. If you look at each one of them, Roche said direct impact on jobs is 1,000 for them. Novartis 1,000. Eli Lilly 3,000 directly employed by them. And J&J about 500. I couldn't quite figure out whether that was the total. So there is still this issue. At the end of the day, I think these are all for drugs in the future, potentially, and we'll see how it all pans out. But it is, to a degree, going down the road that President Trump and the administration is hoping.
Sam, thank you very much. Yeah, really interesting that you've got pharma companies now talking about their own trade deficits and trade surpluses and using that kind of language. Sam Fazeli, senior pharma analyst at Bloomberg Intelligence. So they're evidence that we've got some pharma companies moving, or at least saying they're moving some production around the world. Maybe that takes us onto the auto sector, where we've also heard some similar commentary, not necessarily from Tesla, though. Reports from Tesla due out later on today. Their first quarter earnings will be released. The car giant faces questions about volumes, autonomous driving, and tariffs. All the while, CEO Elon Musk's role at the White House looms over the company's future. For more, let's bring in Bloomberg's Global Autos editor, Craig Trudell. Craig, a lot of different angles on Tesla then, aren't there? There's so many. What are shareholders most interested in? Because I've written a list of about 5 or 6 different things to watch out for in this earnings report. But what really matters to shareholders?
I think, in short, it's really just a reason to believe, a reason to stick with this stock, because the numbers, the actual results are going to be pretty depressing. There's going to need to be some convincing in terms of more affordable models being on the way, because clearly the lineup is in need of a boost. The Model Y has been redesigned. That was a big factor in the first quarter, and maybe one way in which Musk can sort of spin things. But I think there's a lot of concern that even with that model starting to ramp up, that's, whether that's going to be enough to really give this company the lift that it needs, because it's seriously lost momentum.
Craig, we just showed this quote from Wedbush Securities' Dan Ives saying, there's a code red moment for Tesla if Musk doesn't focus on business. But he's meant to be stepping off after 130 days, right? He's a temporary federal hire. Surely that should give investors confidence.
Well, I guess I would push back on that, and I'm confused, honestly, by this sort of, calling of a code red when we know full well that even if we get to that 130-day point, is Elon Musk really going to fully sort of step back from politics and kind of hang it up and be done with things? I'm extremely skeptical of that. I think, a bigger sort of, question that analysts like Ives have to contend with is, if this is a lasting issue where he's really become, sort of the George Soros of the right, the sort of boogeyman for Democrats, how damaging is that going to be to Tesla? Because this is not just going to be a question of how long Doge sticks around. He's someone who's very clearly signaled that he is going to continue to be a force, continue to throw his money around, regardless of how long his role in Doge lasts.
In some ways, Tesla's yesterday's news. And the Chinese EV makers are smashing it at the moment. And we've got this new technology, CATL, talking about, what is it, a 500 km range with a 5-minute charge. This is amazing chemistry. And you wonder is there anything Tesla can do about this? Is there anything the European car makers can do about this other than buy the batteries that these guys are producing?
Yeah, more than 500 kilometers of range, and that we should note is on top of just a few weeks ago BYD announcing more than 400 kilometers of range in 5 minutes. We're talking about the innovation that's taking place in this sector now is no longer from Tesla. It's no longer from the US or Europeans. It's from China.
How long do these batteries last? The average car in the UK at the moment is over 9 years old. Are these batteries going to last 9 years?
I think that's a real key question is what's the sort of fine print of these announcements? They sound really impressive on the front end. I think, when you talk about fast charging in general, it's not necessarily a great idea to do that to your battery over and over again. And I do have some questions about whether this, has sort of some unintended effects on longevity and sort of the health of your vehicle. But no doubt this puts to rest some of the concerns about charging anxiety.
Yeah, definitely.
Bloomberg's Global Autos editor Craig Trudell, we thank you. We're going to talk Ukraine and geopolitics next, so stay with us. This is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I don't know. This sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Welcome back. Half an hour into the Tuesday session here in Europe for European equities. And as you can see, broadly, actually some weakness out there. The Stock 600 is down by around 0.6%. Industrial goods, construction, travel and leisure, also parts is where the weakness is to be found. It's interesting that it's not in healthcare as much as you would have thought, given what is happening with Novo Nordisk this morning. But that sector is still down circa 1% this morning. You do have, you could argue, some safety trades on this morning. Insurance, the grocery sector is doing relatively well. Utilities are up reasonably. So there is a reasonably bifurcated market that we are watching out for this morning. But in aggregate, the 600, Lizzie, down by 0.6%, 0.5%, half of 1%. Let's call it that.
Okay, let's get back to the geopolitics now. Bloomberg has learned that the US is going to hold talks tomorrow in London with Ukrainian and European officials in this latest push to halt Russia's war. US Secretary of State Marco Rubio and Trump's special envoys Steve Witkoff and Keith Kellogg are expected to meet with the foreign ministers and national security advisors of France, Germany, the UK and Ukraine. Meanwhile, Russia has resumed military operations in Ukraine after an Easter truce expired. So let's get more now with Bloomberg's Greg Sullivan. He joins us now from Dubai. Greg, we have heard reports on Friday that the US is open to recognising Crimea as part of Russia. President Zelensky said repeatedly that that is not something that he would accept. He won't cede territory to Russia. Is this meeting in London this week the last push before the US walks away from these talks?
Well, it's hard to say whether it's the absolute last push or not, but what we do know is that it does follow the meetings last week in Paris, where the U.S. did lay out its proposals, one of which, as you said, was recognizing Crimea as Russian. Also, as you said, Zelensky has been pretty firm, saying that Ukraine will not cede territory. We do know a few things about these coming talks and the proposals, including that the U.S. is proposing freezing the conflict along its current lines, which also would be a sort of recognition of the occupation of Russia in these eastern and southern territories in Ukraine, something that Zelensky might not find palatable. Also, as you said, the U.S. has been putting pressure lately, saying that they're prepared to walk away if there isn't signs towards progress towards such a deal. So it will be very interesting to see what does come out of these talks and if any progress is actually made towards a ceasefire.
Greg, if there were to be a ceasefire, how would it be policed? Do we have any details on how that would work?
Well, that's one of the key questions that we'll be watching for this week and moving forward as negotiations happen. It's this idea of security guarantees for Ukraine. How will the powers enforce any kind of ceasefire, make sure neither side is taking up their weapons? It needs to be strong enough to deter Russia. Ukraine has grave concerns that Russia will just regroup and continue the fighting down the line. So something needs to be a deterrent enough to prevent Russia from doing that. But at the same time, Russia has ruled out including NATO countries on Ukrainian soil. Ukraine obviously had wanted to join NATO, seeing it as the best security guarantee, but one part of the U.S. proposal was taking Ukraine's NATO bid off the table. So this will be a key issue to watch for in the coming negotiations.
Greg, thank you. Bloomberg's Greg Sullivan with the latest there on Ukraine. Linked to the energy sector, of course. Let's go to the oil story. Oil has edged higher after tumbling yesterday as investors tracked a risk-off tone across a whole host of asset classes and markets. Now, the oil market has been gripped by big price moves in recent weeks, with trade war tensions and oversupply concerns unpredictably buffeting prices. Let's speak now to Martin Ratz, Chief Commodity Strategist and European Oil and Gas Equity Research Head. at Morgan Stanley. Martin, nice to speak to you. Thanks for joining us. So today, today's an up day for oil, but it's only 1%, which doesn't even scratch the surface now, does it? It's not a big move for oil these days. Give us your best thoughts around a price target for oil. Is it possible?
Yeah, so the oil market right here, right now, is actually not too bad. In the first quarter, demand still grew year on year at quite a reasonable rate. Refining margins are fine, which creates an incentive for refiners to buy crude, pull it through their systems, make refined product. If you look at the slope of the forward curve, the structure can often tell us a lot about the micro balances in the market, and most curves are still in backwardation, what it's called. There's a premium for near-dated delivery over deferred delivery. These are all signals that you would normally associate with a market that is sort of fine. But the problem is these forward-looking balances. The tariffs are a real headwind for the oil-intensive part of the economy. Trade, transport, manufacturing, these are all sectors that are driving oil demand, and they are impacted by tariffs, so the demand outlook has weakened a lot. Non-OPEC supply is still growing, and now OPEC has also said that they will add barrels during the course of the year. And when you put these things together, the second half balances look really weak. We think the market will be oversupplied by 1 million barrels a day or thereabouts. That could grow into 2026, and I think that's what the market is trying to price.
Okay, there's lots to talk about on the demand side. Then we come to the supply side of things, and the focus has been on maybe OPEC plus countries and what they're doing, but also domestically in the US, President Trump wants more production stateside. Do you see any evidence of that, or are we, we weren't very far from $60 a barrel for some time, and a lot of people say that's crucial as to how much US producers are incentivized to sort of put rigs in the ground.
Yeah, really re-accelerating American production is really quite hard. It can grow at a modest pace, but the best days of American production growth, at least for the time being, are behind us. People should not forget that since the start of the U.S. shale, the U.S. shale industry has drilled over 100,000 wells. That is an enormous number if you compare that to any other oil basin around the world. So some really good wells have already been drilled. Slowly but surely, we're starting to drill some wells that are less productive. There are also inflationary pressures on the oil industry itself, partly also from tariffs, big consumer of steel. So break-evens are rising, the price is falling, and against that backdrop, really re-accelerating American oil production is really quite difficult.
Martin, good morning. Can I ask you about the threats on Fed independence? Where does it leave oil if Trump actually does fire Powell? And how much is it about, the expectation of cuts if he's replaced?
Yeah, so the difficulty with oil is that the physical oil market actually is not all that big. So if you look at the market where prices are formed from a physical perspective, that's the seaborne market where people trade tankers with each other. That's roughly a 50 million barrel a day market. If you look at all paper trading in just Brent and WTI alone, in just the first 12 contracts of these forward curves, Brent and WTI futures trading in just the first 12 months is 2,000 million barrels a day of trading, right? So we analyze sort of the 50 million barrels a day, and the financial system has built on top of that a trading system of 2,000 million barrels a day of trading. So you can imagine when the S&P starts to move, when interest rates move, when people are worried about the things like you mentioned, you have these enormous winds blowing through all financial markets. And then the financial selling just takes over, and what's happened precisely in the paper market, in the physical market, takes a back seat for a second. And so you can still see prices impacted by these things as a result of that.
This kind of shape of the market then, and when things are so volatile, so headline driven, what is it that you're looking at to separate the short-term noise from the longer-term trends? What indicators are you watching most closely?
Well, on a medium-term view, say 6 months and beyond, it's all just anticipated supply demand, and we do our barrel counting thing where we look at the U.S. gasoline demand, the Chinese demand, and OPEC policy and all these things. In the short run, we look at a number of other market indicators to build an internally consistent story. One of the things that feeds in that analysis is that in the last couple of weeks we have seen enormous speculative selling. So we're saying the oil market looks weak into the second half. Okay, got that. We're not the only ones who figured it out. In the first week of April, speculators sold at a rate of 35 million barrels a day for 7 days in a row, which is the largest wave of speculative selling in the history of data from the CFTC and ICE. That was followed by last week, where speculators sold another 10 million barrels a day. So in the short run, you need to sort of recognize that speculators are now short to the extent of about 150 million barrels a day of paper oil. So we can have bad news on supply, demand, tariffs, what have you, but it's very, very, very unusual for the speculative community to be as net short as they currently are. And if you then combine that with some other indicators, like we started off the discussion, refining margins are okay, the backwardation in the slope tells an okay story for now, then you sort of also have to recognize that near term, I would expect that the biggest wave of selling is probably behind us. As we go through the summer, seasonal demand does support things a little bit, but then in the second half, we will probably have another period of downward pressure.
If there's a big move out of the dollar, there's a big move out of US assets, is that part of what you're describing in terms of the way that speculators are positioned right now?
Yeah, so I think speculators are by and large informed by anticipated supply-demand balances. Right. Today's balances aren't so bad yet. But when the trends that you highlight are there, then oil gets sort of wrapped up in it. Do
they have to buy though? Do they have to get back to if they're short of the market? Do they need to get back to neutral at some point, or is there a new neutral in terms of financial positioning?
Yeah, so the way that the oil market is usually set up is that the producers want to offload their risk. Yep. So the producers are naturally long, so they want to be financially short.
Yep.
And therefore the speculators tend to be naturally a bit long at the right price. Particularly when the curve is downward sloping, you can pick up a roll yield. So normally speculators are long. But for the second time in history, the first time was September last year, for the second time in history, speculators are now short. So yeah, at some point, I would imagine they will need to neutralize these positions. The question is, of course, at what price? That might be later in the year when the price is lower. But at some point, they need to buy back those barrels, yes.
The dollar is, just factor in a weaker dollar into your thinking. How are you calculating a structurally weaker dollar going forward?
Yeah, that's not so easy. As in, there are effects that point in different directions. Normally, weaker dollar means higher oil prices, but at the moment, it's all part of it's all been wrapped up in sort of one big trade. One of the interesting things is you can say, well, $66 a barrel. Lots weaker than this time last year, lots weaker than a couple of months ago. If you say, well, look, the beneficiary of weak dollar is really gold.
Yeah.
If you look at the ratio of the price of oil relative to the price of gold, the oil to gold ratio, if you take out a brief period during COVID, the oil to gold ratio is at a 100-year low. So you can see from that perspective a degree of the bearishness that is priced in the oil market relative to gold.
Does mean the gold is overpriced, yeah?
Leave that to others.
Nearly got there. Martin, nice to see you. Thank you very much indeed. Martin Ras, the Chief Commodity Strategist, joining us from Morgan Stanley. Coming up, we're going to take a look at what is a big week for European earnings, including the region's biggest company by market cap, which now is SAP. It's going to be reporting numbers after the bell today. A little later on, we'll look ahead to that. That conversation is next. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the programme. Now, tributes have been pouring in for Pope Francis after his death at the age of 88. In his final public message, he appealed for peace in Gaza and Ukraine. President Trump has said that he and the First Lady will attend the funeral.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th Pope in March of 2013. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally. But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. He left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
A look back at the legacy of Pope Francis. Now let's look to what comes next. Bloomberg's Milan Bureau Chief Tommaso Ebhardt joins us for more. Tommaso, what are the steps in choosing the next pontiff?
Hello, good morning from Milan. Pope Francis spent, the last few hours of his papacy discussing the themes that were really close to his heart. The needs to help migrants and the poorest of the society. So the big question here is who will be the next pope, and if the stance that Pope Francis brought up during his papacy will be sustained by the new pope or not. The next steps. So we are still waiting for an official date of the funeral. It's expected to be at the end of this week, most likely Saturday. We already heard many leaders are going to attend the funeral, including Donald Trump, whose stance on immigration was criticized by Pope Francis in the last few months. And then we'll start the conclave, most likely in the first 10 days of May. 135 cardinals, all men, will decide who will be the next pope.
And then we'll spend some time waiting for that white smoke, Tommaso. Who are the front runners to be the next pope?
Yeah, that's a very difficult question to answer. There is a Roman motto who says, who gets into the conclave, the next pope, exit the conclave as a simple cardinal. So the names we can throw out usually are not the one who will be elected pope. But for sure, there are some regions we can look at. One is the U.S. U.S. never had a pope, and there is the Cardinal Burke, who is a archy conservative cardinal, who could be one of the contender. And then if we go back to Italy, there's a natural candidate who is the Secretary of State, Pietro Parolin. He's well known for his diplomacy, was one of the closer people to Pope Francis. Italy, the last Italian Pope died in 1980, so maybe it's turn to go back to Italy. But also, if we look at the period of Pope Francis, we have to look also at the other regions. He said, I'm arriving from the end of the world. So let's look at the other region. We will have the new Pope coming from Africa. There's a chance that will be the first Pope coming from Africa or from Asia. There are a couple of candidates there, one on the Philippines who is seen as very close to the teams that Pope Francis brought, who is Luis Tegel, and the other is from Africa, is Cardinal Taxon from Papa. He would be the first black pope in history. So we'll see, we'll see the smoke coming out of the St. Peter Cathedral, but this will come a couple of weeks from now.
Okay, Tommaso, thank you very much. Bloomberg's Milan Bureau Chief, Tommaso Ebhardt.
Let's take a look at some of the other events that we're watching out for this week. Today we get earnings out of Tesla, SAP and Lockheed Martin. We also tomorrow have the IMF World Bank Spring meetings in Washington. We have the US, UK and Euro area PMIs. And on Thursday, it's the Bank of England Governor Andrew Bailey speaking in Washington at that IMF meeting. Then on Friday, we have more earnings from BNP Paribas, Thales, Nestle, Intel and PepsiCo, as well as Ecodata, the Consumer Sentiment Index out of the University of Michigan. But I want to focus on SAP, those numbers coming later today. Let's bring in Bloomberg's Charlie Wells with a preview. Charlie, Europe's most valuable company, what are investors looking out for?
Yeah, Lizzie, so I think the big question is how warm is SAP's German winter coat in a tariff storm? You're going to get what I'm talking about in just a few moments, but we know that tariff talk has been really difficult on European tech. We can see a slide here year to date, but if we focus in, and this is what investors really need to do in these very uncertain times, is look at some of the key differences here. And one difference here is S&P down, but not quite as bad as a lot of its peers in Europe and also globally, and that is because this company is a little bit insulated. Hence my winter coat reference here. It's insulated because it's got this shift in its customer base away from on-premise computing that's very license-based toward a more lucrative, a kind of better margin cloud subscription-style model. And that is looking like it's a medium-term trend that could support SAP in an uncertain time. The question on this earnings call is going to be how much runway do they have to continue? How much insulation do they have from the uncertainty?
Okay, and what other themes? So that's SAP for us. What are the other themes that we're likely to see this week then, Charlie? We are getting, further into the earnings story.
Yeah, Anna, so it's really going to be a question of what these kind of direct but also indirect impacts of tariff uncertainty could have on companies across the continent. We've got banking in particular, so the expectation is that there's that trading boost at BNP, which is reporting on Thursday, that trading boost similar to what we saw on Wall Street, but also some questions about uncertainty, the uncertainty that could come from a downturn related to tariffs. We're seeing estimations of a significant uptick in loan loss provisions at BNP. I'm thinking about kind of cross-border. BNP, of course, operates cross-border. So does European Pharma. There have been so many questions about these tariffs, maybe unknown sectoral tariffs on pharmaceuticals coming from Donald Trump. We've got that quote from him the day he announced the pause on country-level tariffs of sectoral tariffs that were looming. So I think questions about how these businesses are going to handle that uncertainty. And one of the answers that we're starting to get, we just heard from Roche, which is reporting on Thursday, they're going to be investing $50 billion in the United States. So communicating not just to investors here, but on the other side of the Atlantic as well.
Charlie, thank you. Bloomberg's Charlie Wells with a look ahead to some of the earnings. And Guy, we've got a lot of earnings stories clearly coming our way, but we'll also have some macro, high-frequency data to once again focus in on the PMIs, for example.
We've got the PMI data. Do you ignore the PMI data? Is the soft data, is the survey data telling you the right story at the moment? What we're really waiting for is a catch-up in the hard data to see whether that delivers the same sort of doom-like story that we are getting out of the soft data. We've also got this IMF meeting taking place, which is going to be fascinating. A lot of voices, I think, are going to be coming out of that. And an amazing opportunity to put everybody in the same room, almost, in the same place, in the same city. The opportunity for networking this week just to discuss like sort of how we all talk to each other and think about how we tackle the tariff story, maybe not unilaterally, but multilaterally.
Yeah, you were mentioning some of the sort of sidebar meetings that might be taking place at these events at a time when lots of geopolitical relationships must hugely be in flux. I mean, we heard from the United States warning allies, former allies in some places, to not forge deeper alliances with China because they wouldn't like that. And then the Chinese warning the US to sort of back off. The Chinese want to form the relationships they want, and it's nobody else's business.
She on his Southeast Asia trip saying, don't you be undercutting us when you're doing deals with the US.
Precisely.
It works in all these different directions.
So Narendra Modi's off to see the Crown Prince in Saudi for a couple of days as well. So how the world reorientates, I think, will be really interesting. And I think this week's IMF meeting could be kind of a bit of a speed dating event in terms of setting up some of that story going forward from here. So I think it is going to be interesting just to hear what the tone is out of some of these conversations.
And then as we get into the earnings conversation, it's really interesting to see how much we're going to learn or not from CEOs. How candid are they going to be about the lack of visibility they have?
How much they know.
How much they know, how their earnings commitments or expectations are going to be shaped by tariffs, and whether they'll be, like some of the businesses we've seen, giving us a couple of scenarios and saying it might be this or it might be this other really different scenario, and we just don't know. But it was nicely illustrated by the retailers who met with President Trump yesterday, the lack of visibility they have around supply chains and how difficult it is to manage in this really flux situation.
And they're buying for Christmas. Like, Christmas is coming. Got to think about that. So they're all getting...
it's April.
Yes.
We're just through Easter.
Getting ready for that. So, I think it's a really interesting week in prospect, but who knows? This Trump narrative around Powell, I think, is going to be one that the markets are going to really fixate upon. Does that language continue? Do we get any more clarity there? I think will be one of the really key tests for this week. So all of the kind of the set piece stuff is there, but the wild card is ever present.
And it feeds into the Canadian election campaign. Last week of that, this week. Don't forget the political story. Voting starting on May the 3rd, for early voting now for the May the 3rd Australia federal election. So you've got to tie in the political story as well as the earnings.
I thought we'd done all of those politics. All of those elections were supposed to happen last year. This is not as built. US futures, meanwhile, point higher, slightly inexplicably, maybe just a bounce after the heavy selling of yesterday. But the Powell story has not gone away. We will wait for President Trump to say something else, perhaps, around the Fed chair.
Absolutely, but it does feel at the moment it's two steps backwards, sort of one step forward. Markets do not move in a straight line. As we've seen, obviously there has been some quite significant selling. We are also coming into month end, which is another factor we need to bear in mind as we work our way through the rest of this week. Megan Green is going to be coming up, obviously now an external member at the Bank of England, has been for a while. She's going to be talking to Francine very, very shortly. That conversation at 9:30 a.m. UK time. Bit of policy guidance maybe coming from Megan Green. That is it for the opening trade. We will keep you up to speed with what is happening. The Pulse is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The U.S. president steps up his attacks on the chair of the Federal Reserve, repeating calls for Jay Powell to cut interest rates immediately. We'll be discussing central bank independence and implications of Donald Trump's tariffs in an exclusive conversation with Megan Green from the Bank of England's Monetary Policy Committee. Plus, tributes to the late Pope Francis as attention turns to who will succeed him as head of the Catholic Church. Now, first thing is first, there's a lot going on in the market, so let's straight off start with U.S. equity futures. Look, they're definitely signaling a rebound after some of the sharp losses that we saw yesterday. Again, there's quite a lot of concern surrounding Donald Trump's criticism of Jay Powell. Now, there are a couple of signs of recovery overall in the mood of the markets, or certainly for a demand for riskier assets. The volatile backdrop, though, to markets drew investor to havens. Gold actually surging to a new fresh record high of just above 3,500 an ounce. The yen also strengthening beyond 140 per dollar for the first time since September. The European markets map, again, they track a lot of this, so we want to start with cross asset. But if you look at the CAC 40, it's down some 0.8%. Interesting that the FTSE is gaining 0.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump is escalating his attacks on Jay Powell, adding to investor jitters over the Fed's independence and the chair's position. Now, since Thursday, the president has taken aim at the Fed chief. In his latest social media post, the president warned that the U.S. economy could slow unless interest rates were lowered immediately, adding Powell would be responsible for any economic slowdown. Now, gold hitting a record on concern that President Trump will fire Powell, triggering a flight from U.S. stocks, bonds, and the dollar. Meanwhile, Narendra Modi and J.D. Vance have held trade talks in India, the White House hailing the significant progress, saying the two sides had a roadmap for a possible deal. Now, this comes as Walmart, Target, and other retailers met with Trump to discuss relief from tariffs. And finally, Bloomberg Economics estimates that global GDP may take a $2 trillion hit by the end of 2027 due to tariffs. To unpack all of this, we're very pleased to be joined by Banu Baweja, Chief Strategist at UBS Investment Bank, and Brendan Murray, Global Trade Czar. None have slept in the last 3 weeks. Thank you for joining us. Banu, I mean, look, there's quite a lot going on, not on only tariffs and the fact that certainly here in the UK they feel deflationary for the moment, but the focus is now on the Fed and what Donald Trump will do with the Fed chair. How concerning is that for markets?
Look, I mean, if it really comes to pass that he does compromise the independence of the Fed, we don't think that will happen. But if it does come to pass that does happen, it's going to make the tariff saga look like a picnic, right? That's a serious problem. You're compromising the exorbitant privilege of the U.S. You're compromising interest rates in the U.S. You're compromising the risk-free rate of the world, the cost of capital of the world. I think they're quite sensitive to the bond market. I mean, the last time when the bond market rebelled against them, it was the bond market, not the stock market, that got Scott Bessent to put a word in Donald Trump's ear saying we really should back off, and he did back off, right? There was a pause on the reciprocal tariffs. So I think they do care about the bond market, and that's why you have to believe, your rational mind really has to believe that they will not go so far as to compromise the independence of the Fed. It's a low probability event. The negative payoff from that is just so high.
Yeah, but Banu, is it just trying to find, a boogeyman, basically? Someone
yes. I mean, I think that's exactly what it is. I think they understand that this is going to be difficult for growth. They understand that they believe in tariffs philosophically, and if they believe in tariffs philosophically, they are also saying we're ready to take a hit on growth, but of course it will be nice if you could pin it on someone, and so I think that's the context in which they're talking about it. I don't think you'll seriously compromise the independence. By the way, the markets don't either. So yesterday the stock market was down, but if you look at inflation break-evens, break-evens were fine. I mean, the 10-year inflation break-even is sitting at 2.3, which is close to the long-term average of the Fed, and there's no real volatility in it. If you're compromising the independence of the Fed, inflation break-evens will go much, much higher. So not just real yields, which are already high because of legitimate fiscal concerns in the U.S. But if you compromise the Fed's independence and you start replacing the 7 governors much quicker than they ought to be replaced, then inflation break-evens will explode higher, and you will see stocks, dollar, bonds suffering at the same time. You're not seeing inflation get hurt right now.
And Brendan, in terms of tariffs, so we have J.D. Vance in India. I mean, this is a crucial relationship. But again, they were allies, but they still got slammed with tariffs. So it'll be interesting to see what happens over the next 48 hours.
Yeah, exactly. So the Trump administration has caused a lot of disruption in markets because of the tariffs that they put in place and the threat of even higher tariffs. So what they need to do now is deliver some deals or the pathway to deals. And I think what you're seeing with India is a step in the right direction. It's a little like announcing your wedding, though. It's a lot of happy talk at the beginning, but then you and your lawyers sit down and hammer out the prenup, and it gets complicated. So I think it's a step in the right direction. We're going to see South Korea in Washington later this week. That's a key trading partner with a lot of automotive and semiconductor industry connections there. The Thai delegation is next, and so we'll have to see if the steps keep going in the right direction, because it just gets tougher from here.
Bernard, what does the U.S. need from India right now?
Well, they need some partnerships on a lot of different things, from energy to things that they're not going to get from China anymore. So I think we're going to, India has traditionally been a very tough trade negotiating partner. The U.S. has found that administration after administration. So we'll see what India brings to the table. But the U.S. is definitely trying to make a U.S.-India trade deal something that they can really go back to other countries and say, look, this was hard from the outset, but we got through it.
Banu, what's priced in the markets right now? Because again, there's a lot of maybe deflationary. I don't know whether it's happy talk or because growth actually is really being hit across the world. But the markets are still quite cool about it.
So the markets, I think, are pricing in these tariffs coming straight back down, right? So I mean, if you look at the effective tariff rate in the U.S., it is still 24%. What was announced on April 2nd was 24 to 25%. Today, it is still 24%, and it's distributed completely differently because it's China's 145%. And you've taken down the reciprocal tariffs. But if you look at the dollar amount of tariffs, or if you look at the effective tariff rate, it's still very, very high. Is the market pricing anywhere close to that? No chance. The market's not pricing that because, I mean, if you look at earnings expectations, there's still low double digits earnings expectations over the next 12 months, right? That's unlikely. I mean, if you're going to see this kind of tariff hit, or even if China tariffs reduce from 145% to 60%, the kind of hit you're going to see on domestic demand, right? GDP may be the wrong lens, Francine, because imports are going to collapse, and as import collapses, it reduces the hit to GDP, right? But if you look at domestic demand, that very likely will be in a recessionary state. That very likely will go negative in the second half of this year, and that could mean an earnings stall. So I don't think that's priced.
But so why the mismatch again? And there does seem to be a belief, and I've been told, by people that are close to President Trump, that actually people just don't believe what he says at face value.
So this is exactly it. I think the markets, they sleptwalk into these tariffs because they fundamentally didn't believe that this was an ideological position, and they also fundamentally believed, and I think there is a little bit of inertia in that belief. The market still believes that when push comes to shove, Trump will back off, so they do not expect these tariffs to go through. I don't think these tariffs are priced, or even a much lower level of tariffs like China at 60%. even that, I don't think it's priced. If you look at global assets, are they pricing in global growth at 2.2, 2.3%, which is where it will be if you have even 60% tariffs in China? No, you're pricing in close to 3.5% growth, so slightly below trend, but trend growth is what is being priced, nowhere close to sort of a domestic demand recession.
Brendan, where are we with China?
Well, the talks are going nowhere. Basically, the two leaders can't agree on the conditions of any sort of beginning of any discussions, and so we're at a stalemate. And at the moment, the U.S. is trying to line up its trading allies. China is warning other countries, don't go against our interests with those alliances. So they're just kind of drifting apart, and that's going to be a real focus, especially this week with the IMF World Bank meetings in Washington. This is going to sort of dominate the headlines from the talks that will take place on the sidelines and in the main discussions among the finance ministers and central bankers.
And Bennett, does this put the Fed actually in a very awkward position? Because even if they cut rates, is there going to be a reticence to show that they're independent?
Listen, whether you compromise their independence or not, the Fed is in a really difficult position. And remember, we haven't seen this in a long time. Growth and inflation going completely in opposite directions. I mean, this is the kind of stuff we used to see in the 1970s and the 1980s. We haven't seen this. And again, you asked me earlier if the market's priced this. No, the market's not pricing in these stagflationary pressures. What does the Fed do? Well, the textbook answer, and this is what I think the Fed will do, is that when you get a supply-side shock, you do nothing to begin with and then turn very dovish, right? So you are going to see, starting the June print in US CPI, you're going to start seeing some serious numbers, and you're probably going to be at 4.5%, maybe higher core PCE from Q4 of this year to Q2 of next year if these tariffs don't come down significantly. The Fed's it's going to be difficult for the Fed to move until it sees the whites of the eyes of the labor market slowing, which again should happen from Q3 of this year. So we think the most likely time the Fed begins to cut, despite high inflation, is September. So, Trump's been putting pressure that they should go right now. I don't think the Fed is ready to go right now. I think they will have to wait for inflation or the peak of inflation to be seen, labor market to weaken. So I think they begin in September and then they go hard.
What's hard?
So hard is through neutral, right? Over the next 2.5 years, we think the Fed, so we're at 4.5 right now, the Fed gets to 2.25 by 2027. So really a halving of cuts. But what's important is that although the Fed's going to cut, I don't think the long end's going to come in that much because of the degree of fiscal supply and the lack of demand from the rest of the world. The long end actually really lags. So 2.25 decline in Fed rates, probably a 60, 70 basis points decline in the long end.
And Brendan, we also had this report from Bloomberg Economics basically saying, $2 trillion is quite a lot. And again, as Banu says, is that at the moment there's probabilities. So the market is also not pricing in things because they're looking for the kind of the backstop. I mean, the range of how much the U.S. economy could suffer is quite broad. Absolutely. So the Bloomberg Economics marked down not only the U.S. growth outlook for this year and next, but several other major trading engines. What we're going to see, the big date for the real economy is July 2nd. That's when the 90-day reprieve expires. In the meantime, you're going to see companies try to avoid tariffs, try to stop orders. They're going to go through inventories, and there's going to be all this disruption, all this sort of confusion that is not going to give the Fed a very clear picture of what's actually going on. So it's just going to muddle the picture in the next 6 to 8 weeks, and it's going to make the job of the central bank very difficult to get a good read on what's happening with the economy. But so where do you see it first in the labor force? Actually, a disruption. So initial jobless claims are going to start rising, we think, by late Q2. Quarter. Yeah, but no, late Q2, initial jobless claims are going to start rising. By the fourth quarter, you'll see negative payrolls, but payrolls will start declining, we think. Hiring. So as you know, hiring rates have come down, but firing rates have not picked up. So I think firing rates begin to pick up late Q2. Through Q3, you will see weaker payrolls. By the time we get to Q4, you think negative payrolls. And already we're seeing a lot of chief executives saying, look, they're worried about their spending, right? And so consumption will also be hit at the same time, or? So consumption was already slowing before the tariffs were introduced. Remember, because we've come from 3 years where the U.S. economy, particularly U.S. consumption, has been on steroids. So that, in any case, you saw the effects of that fiscal stimulus that you saw in the Biden administration, and also the immigration increase that led to consumption going up. So the consumption was already slowing.
no doubt, real disposable incomes get hit and consumption gets hurt even more, but also CapEx, right? I mean, who's going to be investing right now? Even if you take tariffs back, there's enough uncertainty out there. Our team has done some numbers which suggest that, first, uncertainty right now is 4 standard deviations higher than normal, and our team has done numbers which suggest that every 1 standard deviation increase in uncertainty is 35 basis points hit to the U.S. economy. So it's a serious hit.
Yeah, I mean, I guess what people in finance circles say, Brendan, is that because this is man-made, it can be reversed quite quickly, and that's the hope. Is there any truth in that?
Well,
there's chatter in the White House that maybe they've gone too far.
Yeah, I mean, there's some evidence over the past 2.5 months that the president and his advisors have their limits. You know, the bond market, for instance, if that starts to show signs of buckling under this cloud of uncertainty. So, I think everything that Donald Trump says you have to take with a grain of salt, and he'll have his pain threshold. It just depends on this is a game of whose pain thresholds are higher, and he has his, especially going into the next couple of quarters. If the real economy starts to buckle, then his political reality changes.
If you do see him backing off, there will still be a minor growth impact. There is no doubt that there will still be a growth impact, but what you hope to avoid is a major inflation impact, right? Because effectively, if you don't reduce tariffs to China, you're going to stop trading with your 3rd largest trading partner. That's a major inflation hit. So what we're hoping is that corporate America can convince the Trump administration, and therefore Trump, to back off soon. And if that happens, then what we can look forward to is that the inflation impact and sort of the dilemma for the Fed is not seen. Some growth impact, I think that's already baked in the cake.
Banu, thank you so much. Banu Baweja, their chief strategist at UBS Investment Bank, and Brendan Murray, Bloomberg's global trade czar. Now, coming up, tributes pour in for Pope Francis following his death at the age of 88. We look back at the pontiff's legacy next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Well, Well, tributes are pouring in for Francis, Pope after his death at the age of 88. Italy's Prime Minister, Giorgia Meloni, called him a great shepherd, while President Trump says he and the First Lady will attend the Pope's funeral. Meanwhile, cardinals will gather soon in Rome to elect a successor. Well, for more, Bloomberg's managing editor for Southern Europe, Tommaso Ebhardt, joins us. Tommaso, good morning. So what actually happens next?
Hello, good morning. I have in front of me the front page of the Italian main newspaper, Il Corriere della Sera, the Pope of the last one. This is how Francis will be remembered, the Pope who arrived from the end of the world, as he used to say. The news from a few minutes ago is that the funeral of Pope Francis will be held Saturday at 10 a.m. In Rome. We are expecting coming to Italy leaders from all over the globe. President Donald Trump, whose stance on immigration was heavily criticized by Pope Francis, will attend the funeral with the First Lady. Macron from France already said he will be here. I was reading Italian media, they are expecting also Zelensky to come to the funeral. So Rome will somehow be again the center of the world at the end of this week for the funeral of Pope Francis, who died yesterday at 88 in the simple apartment he had chosen to live as a pope. His papacy will be remembered for austerity, simplicity, and from his stance being closer to the last one, as the Italian media are reporting today.
Tommy, thanks so much. Tommaso Ebhardt there with the very latest. Now, of course, the spiritual leader of the world's 1.4 billion Catholics since March 2013, Pope Francis hailed from Argentina, making him the first pope from the Americas, as well as the first Jesuit to hold the position. Here's a look back at his life and legacy.
Pope Francis will be remembered as a spiritual leader who encouraged Catholics to embrace more compassionate views on many issues of church doctrine. But his legacy as pontiff will also be marked by his failure to deal decisively with past abuse by clergy. Born Jorge Mario Bergoglio in Buenos Aires, he entered the seminary in his 20s and joined the Jesuit order, known for its work on behalf of the poor and for social justice. Bergoglio later became a bishop of Argentina's largest archdiocese and eventually a cardinal before being elected the 266th pope in March of 2013. He captivated many liberal non-Catholics with his focus on poverty and human suffering at a time when far-right political groups were on the rise globally. But Francis's expansive message faced pushback from a polarized clergy and hidebound Vatican bureaucracy. He abolished the highest level of secrecy used to protect pedophiles within the church, yet largely failed to satisfy victims' demands for accountability. He advocated for a freer discussion of homosexuality, divorce, and the role of women in the church, but progressives didn't find him revolutionary enough, while conservative Catholics felt he went too far. He left a final institutional legacy reconfiguring the College of Cardinals that will select the next pope, making it more likely that person will be from Asia or Africa.
Well, with us now is John Studinsky, Vice Chairman of PIMCO and founder of the charities the Arise Foundation and the Genesis Foundation. John, you're also a very close personal friend to Pope Francis. Now, he'll be buried in a modest grave, turning away centuries of tradition to embrace the humility that we've seen from him since 2013. How will you remember him?
I remember him as someone who, on one level, as your colleague was just saying, lives in the modest apartment. He did not want to move into the 12-room apartment in the Apostolic Palace, which, as you know, it's very grand, marble, it's very cold, it's a bit like a tomb. He thought, what am I going to do there? He lives in the guest house. He would dine and he would be available to have dinner, and there was always the joke in that he would always like to eat off the buffet. So there would be times when we'd walk in, I'd stay at the guest house with him. He'd be sitting in the corner sometimes, and you knew if he was sitting on his own, he wanted to eat and be on his own. But quite often, he would come into the room. He'd see who else in the room. And if he decided he wanted to be social, he would sit and join them. So he had an element of humility, an element of humor. He loved to play jokes. but also he had a great sense of humanity and compassion. And I think that's probably more than anything else. That's how he's going to be remembered. The images of him in the first Last Supper, washing the feet, the images of him even last week going to the prison, and of course making the jokes with the prisoners saying, "You're here, they did manage to catch me, otherwise I'd be here." And he had a great sense of humor, and I also saw that humor a lot. He would often talk to me about his meetings with world leaders, and they were always slotted in the diary for 30 minutes. And if he didn't like the world leader or didn't feel comfortable with them, he would find a way to reduce the meeting to 10 minutes. So I always got a sense from talking to him as to which leaders he respected or was engaged with, and which leaders he wanted to reduce their time slot from 30 to 20 to 10 minutes.
And he was tough, actually. He was also tough on some of the world leaders and some of their stances, right?
Oh,
he was quite tough on President Trump and J.D. Vance when it came to deportation of immigrants.
Yeah, I've used the analogy that there's an Old Testament, rather stern, imperial Pope Francis, and there's a New Testament, Christ-like, compassionate, non-judgmental New Testament Pope Francis. And those two coexisted. And depending on the message, depending on the audience, and depending on what he was trying to accomplish. But he knew exactly who he was, he knew where he came from, and he knew where he was going.
John, is there a worry that actually this legacy of compassion, but also being interested in world affairs, putting poverty, I guess, at the center of his focus, is lost with the next pope?
Well, this pope is focused very much on inclusivity, broadening how the Catholic Church welcomed people into it and accepting people. And also, he didn't like people who were indifferent to poverty. I think when we're talking about legacies, we have to be careful. Everyone wants to write his legacy this week. But let's look at the last two popes. It took years for people to appreciate the role that John Paul II has played in history. Pope Benedict, people just originally saw him as a transitional pope, as an administrator, but now he's actually regarded through his writings, and his book Jesus of Nazareth is extraordinary, as probably one of the most important German theologians in 200 years. So you need to give popes and their legacies some time to really understand their impact and what happens. And sometimes we'll see what happens with the conclave. Sometimes conclaves are a reaction. Sometimes they're a reaffirmation.
What do you think will happen? I mean, it's impossible because of the different factions, right? And this pope actually almost came out of nowhere.
Well, he was very much the sort of runner-up candidate at the time Pope Benedict was elected. Now you have 137 cardinals who are able to vote. Canon law suggests there'd be about 120 that would be allowed to vote. It depends. There's factions. What happens in the room? But we do know one thing from the book and the movie Conclave: those who perhaps aspire to it are not necessarily the ones the Holy Spirit accepts.
John, thank you so much for those words of wisdom. John Studinsky there, PIMCO Vice Chairman, and of course the announcement also of the funeral for this Saturday at 10 a.m. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a darkening global economic backdrop has opened the door to quicker rate cuts from the Bank of England. That's as officials eye the impact of Trump's tariffs, a cooling labor market, and tumbling energy prices. Now, markets are fully pricing 3/4 points reduction this year and a 50% chance of a fourth with a cut next month, all but certain. Well, joining us now for an exclusive interview is Megan Green, member of the Monetary Policy Committee at the Bank of England, and welcome also to our radio listeners. Megan, as always, thank you so much for giving us a little bit of your very busy schedules. Now, markets are now gaining conviction that the BOE will, probably deliver another rate cut next month and more than 3 rate cuts by the end of the year. How comfortable are you with that pricing?
Look, market pricing has moved around a whole lot over the past couple of weeks, and it's also worth pointing out that not all of that is focused on what's going on in the UK. So traditionally, about a third of the moves in the gilt curve have been driven by things happening outside the UK. These days, it's about half that's been driven by things happening outside the UK. So part of those moves, I think, reflect what's going on globally. And, we're just about to go into an interest rate round, so we'll have to see. But I would highlight that those market moves don't all reflect fundamentals in the UK.
Because what, of uncertainties? If you look at, there seems to be a lot of disinflationary kind of impact from falling energy prices, weaker dollar, tightening financial conditions, global demand. Does that point to a cut, in May?
So look, there are factors that are both inflationary and disinflationary. I'm particularly concerned. We've had weakness in output for about 9 months now, and we're trying to figure out what the big driver of that is, whether it's demand or supply driven. I think there are reasons to think it's both, actually, but I'm more concerned about the supply side, and that actually on balance would be inflationary. So that's part of it. When it comes to tariffs and the developments over the past couple of weeks, there, again, are both inflationary and disinflationary impulses. So when it comes to tariffs in particular, for the UK, we're a small open economy, right? The US is our biggest single country trade partner, but the EU, of course, is our biggest trade partner overall. So if you have export substitution, then that would tend to push down on growth and inflation. If you have trade diversion from other countries that are trying to find a new home for their markets, that also pushes down on inflation. But we saw during the pandemic that if you have a repatterning of supply chains, that can push up on inflation. And also if we have trade fragmentation writ large, then that tends to reduce knowledge spillovers, that reduces potential growth, that tends to be inflationary. So something you've mentioned was exchange rates. Yep. And And those have not gone as the economic theory would suggest. Normally, if the U.S. announces or imposes unilateral tariffs on other countries, the theory suggests the dollar should appreciate. The opposite has actually happened. And so that in and of itself could be disinflationary for the UK. But of course, as I mentioned, the EU is the UK's biggest trade partner, and the euro has appreciated. So net, if you look at the kind of sterling exchange rate index, the pound's up a little bit. There's a ton of uncertainty around this, but there are both inflationary and disinflationary forces.
But are you concerned about the slight recent strength in pound? Does that change actually, tightening financial conditions?
So it does. I mean, the currencies have been moving a lot recently as well. We've also seen, off the back of previous kind of structural shift after the global financial crisis, after COVID, the dollar didn't always behave immediately, as the theory would suggest. It weakened and then subsequently rebounded. So I think it's a bit too early to say kind of where the dust is going to settle on currencies. But I will say if the dollar continues to depreciate, on balance, that would be disinflationary for the UK, and if the opposite happens, less so.
So are you worried that, and you said in the past actually that there's a danger that it could, muddy the water on inflation, the moves in pounds. So are you worried that there could be a reverse and then it becomes an upward pressure on inflation quite quickly?
It could be. That's right. Currency forecasters have the hardest job, second only to energy forecasters. And like I said, it's been really volatile. We're not quite sure where the dust will settle. If the pound were to strengthen more, actually then we'll be importing disinflationary forces. If the pound were to depreciate, then the opposite would happen. So it just underscores the amount of uncertainty that we're looking at, given that we are basing our policy now on where we expect the economy to be in a year and a half, 2 years' time. It's pretty difficult.
And how do you see domestic policy actually impacting behavior? For example, the NICS policy in terms of companies, but also consumers.
Yeah, so the combination of the NICS and the increase in the national living wage is something we've been looking at a lot. We've asked companies through our agency network how they plan on adjusting in response to that. And we've also looked at other surveys that have been done. There are a number of different margins of adjustment. So you could, decrease employment, you could decrease hours, you could offer lower wage increases. You could have it eat into profits. You could boost productivity. When we ask firms how they plan on responding and lay those out, they basically say yes. We're going to do those. And so it's a bit too early. It just kicked in April, right? It's a bit too early to say exactly what the margins of adjustment are. So far, it seems like eating into profits will be the most immediate one. But further down the line, it could end up feeding through into kind of labor quantities. And that's a concern of ours, certainly. So we have incorporated the NICS and the national living wage into our inflation forecast. It pushes up on inflation a little bit by about 0.2 percentage points. So that's not massive, but it is something. But the big risk, I think, is that there could be a shakeout in the labor market. We could see unemployment tick up. There are no signs of that yet, actually, even though the NICS and the national living wage have come to be. So it might be a bit too soon. We see in the kind of forward-looking PMI employment indices, they were really falling before. They weren't performing well, but actually in the most recent one, they've ticked up, which suggests a lot of that was around kind of sentiment around the NICS rather than actual expected behavior.
But has the labor force dynamic changed, actually, for the worse since 2020?
Since 2020.
COVID.
Yeah, I mean, what we've seen is that the labor market has held up surprisingly well in the UK as it has across developed economies, right? So we have unemployment of around 4.4%. That's pretty low. I should provide a big health warning with our labor market data because the labor force survey hasn't been getting as many responses as it did pre-COVID. And that's been the case everywhere, but especially so in the UK. So it's hard to get a real read on the labor market. That said, we look at a bunch of other indicators and series. We have our own kind of indicator-based models, and underlying employment is growing pretty slowly. Unemployment, is ticking up very slowly. We've seen the labor market weakening since COVID, slowly, again, not as quickly as one might have expected, and wage growth remains pretty high. Now, that's wage growth according to the labor force survey again, and it's pretty volatile and actually ticked up at the end of last year. It's since started to come back down. But if we look at other metrics of wage growth, they're also pretty high. And that's important because that's a huge input into services inflation, which tends to be more domestically driven. And so that's something that we're looking at a lot. Services inflation in the UK is around 5%. It's much higher than other developed economies, and that's a sign that maybe there is some inflation persistence in the UK economy.
I was going to ask you, what part of the UK inflation spectrum are you most worried about? Is it services or private sector wages?
So I would say I'm more worried about services inflation. It actually has surprised on the downside more recently, and I should highlight that the disinflationary process is underway and continues to be underway as we see it in the data. I'm worried about services inflation, as I mentioned, because it is an indicator of domestically driven inflation, which we can actually do something about. It's the biggest contributor to inflation in the UK. The biggest part of it is actually pay growth, which is why I'm also focused on wages. But one factor that feeds into wage growth, of course, is inflation expectations. And we've seen household inflation expectations rise. And that goes for both short-term measures and medium-term measures. The latter is a bit more worrisome, actually. You don't usually see those rise. So I think they remain well anchored. We've looked at kind of the relationship between inflation expectations and the economy pre-COVID and come up with kind of bands of reasonable inflation expectations now. And where we are is within those bands, but towards the top of it. So it is something I'm looking at as another sign of inflation persistence.
Everything seems to, it's changing so quickly, and the markets are changing so quickly. Is there anything that that you can confidently say will not change?
That won't change. That we'll have a lot of uncertainty for a while is one thing. I mean, there is a lot of volatility. The markets haven't actually really responded as you would expect in the face of a risk-off environment and that amount of volatility. And so that does inject quite a lot of uncertainty. And there's, policy uncertainty coming out of the U.S. as well.
I mean, I was looking at the 30-year borrowing cost for the UK, around 5.35%. I mean, it's the highest they've been this century. Is that a message to policymakers from bond vigilantes, or how do you see this?
So it could be, but it could also just be a reflection on what's happening in the U.S. in particular, and a read-over. That's what we've seen since COVID, is that there's just significant read-over automatically, even though the structure of the U.S. and the UK economies are quite different. Because the UK is a small, open economy, it does get dragged around by developments happening elsewhere.
Yeah, how much, I mean, we're trying to theorize about what the Fed does and when they can start cutting if labor goes down in like the third quarter. Is that when they start cutting aggressively? But what's your path for interest rate cuts in the next, 6 to 8 months for the Bank of England?
For the Bank of England. So I have been on the more cautious side of our rate cutting cycle because of all these indicators that there could be inflation persistence. There's also uncertainty. I do think there are risks on both sides, though, actually. So I'm also careful in our lingo. I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk, though. And so we'll have to see how that develops going forward.
Is there anything that actually, I mean, first of all, is it so difficult to know where the current neutral rate is? Yes. Do you have an idea of where it is? Because that'd be good to guide the markets towards that.
Yeah, as you know, we use a lot of different methodologies to try to estimate the real neutral rate. We use financial markets indicators, we use surveys, we ask investors, we use macro models, and they all have massive bands of uncertainty. So I won't give you a point forecast. In February, we put out kind of our analysis on this and showed that depending on which methodology you use, the long-run neutral rate has probably gone up by between 25 basis points and 150 basis points. So that's a pretty wide band. But what we can conclude is it's probably gone up, and this is something I've believed for a while. So I think it's higher than where it was. When we ask investors, they say somewhere between 3.25 and 3.5%. I don't think that's totally unreasonable.
Megan, is there any case that the UK has a competitive advantage with the tariffs? Because given they're at a baseline 10%, which offers, I guess, more certainty for businesses than in the EU where they're still negotiating.
Yeah, so again, we'll have to know when the dust settles, but the EU was given a lower tariff rate than many other countries. And so that does end up being a bit of a competitive advantage, particularly with respect to the EU. So we'll see what happens with the EU tariffs. But if the UK does end up with lower tariffs than the EU, then you might have some kind of substitution. So actually, normally trade diversion, you think of it as disinflationary for the UK, because you think of, for example, products coming from Asia looking for a market, them offering lower prices to find access to the market. But actually, you could get trade diversion from the EU because the UK has lower tariffs. It all depends on how much substitution there really is.
When you look at the complex over the next couple of months, is there a point where if tariffs come down with, say, China or India, does that give you hope for a more settled economic backdrop worldwide, or is it still going to be messy?
So I think there's going to be a lot of volatility in terms of policymaking regardless. I don't expect us to know exactly what the global trade landscape or financial landscape will look like anytime too soon.
I know there's, we led the show actually talking about central bank independence because of what Donald Trump was saying about Jay Powell. I mean, what's, as a central banker sitting on the MPC, how does the BOE react to this?
So, credibility is the currency of central banks, and I think independence is quite an important piece of that. That when we say we will hit our target, and the target for the Bank of England is provided by Treasury, but we will hit our target. I think we can do so credibly because we're free to make the decisions that we believe will most effectively achieve that. And so I think central bank independence is absolutely crucial.
Megan, thank you so much for joining us today. That was, of course, Megan Green, member of the Bank of England's Monetary Policy Committee, joining us for an exclusive conversation. Now, coming up, Tesla reports today investors will be keeping a keen eye on performance as questions are raised over Elon Musk's role with the federal government. That's next, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in London. Now, Bloomberg has learned that the U.S. will hold talks in London tomorrow with Ukrainian and European officials in the latest push to halt Russia's war. Now, the U.S. Secretary of State, Marco Rubio, and Trump's special envoys, Steve Witkoff and Keith Kellogg, are expected to meet with the foreign ministers from France, Germany, the U.K., and Ukraine. Now, on the ground, Russia has resumed military operations in Ukraine after an Easter truce expired. Now, Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Well, Harvard's president says the freeze happened after it refused to follow what it calls illegal demands to make changes to governance, discipline, and hiring policies, as well as diversity programs. Well, President Trump has accused Harvard of failing to combat anti-Semitism on campus. And Bloomberg has learned that Nomura has agreed to buy Macquarie's U.S. and European public asset management business for $1.8 billion. The deal marks Nomura's most significant overseas acquisition since it bought Lehman Brothers assets back in 2008. Now, the transaction is part of the Japanese firm's efforts to diversify away from its domestic market and trading operations, and appears to be a big bet on the future strength of the U.S. market. And shares in Novo Nordisk slumping this morning. That's after a pill from rival Eli Lilly helped patients shed weight and control blood sugar, about as well as it injected blockbuster Ozempic. Now, the news from Lilly puts pressure on Novo, whose market value has dropped by a third since the start of the year. It's now fallen to become Europe's 5th biggest company by market cap. Now, a host of Europe's largest firms report earnings this week. We'll be looking ahead with Bloomberg's Charlie Wells in a moment. But first, Tesla reports first quarter numbers later today. The EV maker faces questions about volumes, autonomous driving, and tariffs. All the while, the chief executive, Elon Musk's role in the White House, looms over the company's future. So for more, let's bring in Bloomberg's global autos editor and Elon Musk expert, Craig Trudell. So, Craig, thank you so much for joining us. I mean, there's so many people, and actually, whether it be insiders or shareholders, saying Tesla's not doing great because he focuses so much on the government and Doge that he's really keeping his eyes off the ball.
Yeah, I think it's sort of reminiscent of a few years ago, right, when he decided to buy Twitter, now X, and that became such a huge issue for the company that the level of attention that he was paying, or lack thereof, was really sort of front and center. I think it's similar in this case, but also, at least in the Twitter case, he was still pursuing business as opposed to politics, and so you could quibble with his leadership of Twitter, and yet you could sort of take or leave whether you really wanted to care about that or not. I think it's a whole different matter when your vehicle becomes a political object, and whether or not you want to sort of buy into that as someone looking at buying a new car. But
great. So is the problem that he's basically too political, or that he also doesn't have anyone to take his role at Tesla?
I think that's also an entirely fair question, because some of the folks who sort of push back against this notion that this should be such a front and center issue say, well, no one buys a car based on the CEO of the car company from which they're buying. But, there isn't a car company out there that is so synonymous with the CEO as Tesla. And so this is indeed an issue of how do you sort of, separate, the company from the CEO, right. And, is there, anyone waiting in the wings? I think we did see in the past, after that Twitter saga, Tesla staged this event where they had, something like 15 executives sort of line up alongside Musk, for an investor day. We haven't seen that sort of effort to kind of, demonstrate the bench behind him. Maybe we'll see that again from them this year as a result of all the concerns about his leadership.
But Craig, he has tried to basically say, look, don't worry about the concerns about Washington. I've got this. But it hasn't quite worked out.
Yeah, and I think a big concern that you have is, yes, the refresh Model Y is coming to market. That's starting to ramp up, and that may allay some of the concerns about the brand damage that he's doing. But what do you have other than that? The Cybertruck is not proving to be the sort of big seller that Musk thought it would be. And, the Model 3 refresh did not do well whatsoever. The Model S and X are really long in the tooth. There's also, concerns about whether or not you have a sort of more affordable model waiting in the wings, which is something that, a year ago the company was touting, and there have been reports just in the last couple of days that those may actually be delayed. So if that is the case, you really have an issue of it's not just first quarter weakness sales-wise, that bleeds into this quarter as well.
Craig, elsewhere in the EV space, CATL is also unveiling innovations in batteries. That feels like a big deal.
Huge deal, and this may be something that Tesla is able to take advantage of, in that they are a big CATL customer. but it's not necessarily a distinguishing feature, obviously, right? If CATL is selling these batteries widely, and you do have this really impressive, fascinating sort of one-upsmanship going on in the Chinese market, where just a few weeks back, BYD was drawing a lot of attention for its 5-minute batteries that charged up with 400 kilometers of range. Now you've got CATL coming in soon thereafter saying, well, we can do better than that, even more than 500 kilometers. So this is really a case where, the innovation we used to think of Tesla being on the leading edge of that, now it's really the Chinese that are out in front in terms of the electric vehicle space.
So interesting, Craig. Thank you so much. Craig Trudell there with the very latest, of course, on Elon Musk and CATL. Now, Europe's largest firms also continue to report earnings this week. SAP on deck for later today as trade tensions raise questions over the company's forward guidance. Well, Charlie Wells is here to talk us through some of the earnings reports. So L'Oreal shares, let's start with a bit of beauty. You know what? Why not? It's Tuesday morning. Those shares gaining this morning. What's behind it?
Yeah, Francine, it's kind of a welcome back from that long holiday weekend, and L'Oreal reported better than expected earnings for the first quarter, and they saw a real jump in their Luxe division. And now that is kind of representative of the power that the higher-end consumer has had across the globe. And I think going forward, the question will be, will they be able to propel this company and other consumer companies? But certainly the answer today, as we're looking in the markets, is very positive. And if you think back to those L'Oreal earnings, what was really striking were like-for-like sales, up 3.5% in the quarter. Compare that to the estimate of 1.3%. So a significant jump there. Great story in the market for that business this morning.
And so what are analysts expecting from SAP?
So look, this is Europe's largest company. And I think, we're talking about Tesla, we're talking about tariffs. The question is, how does European tech respond to tariffs, right? Because that story has not been good for the tech sector so far. SAP has been a little bit insulated because they have this longer-term trend of customers moving from on-premise, very licensed technology to cloud-based, more subscription-style technology. That's insulating them a little bit. They're performing not great, but a little bit better than their peers in Europe. Does that continue? How much runway does this have? I think that's what we're going to hear about on this call later today.
Okay, and then we have the European banking season. Craig can't wait. He's so happy he's in cars and not banks. BNP kicking off. They're reporting it on Thursday. What can we expect?
I mean, look, it's sort of like the European Champions League is starting up. And basically, I think, is it going to look like what we saw on Wall Street? Are we going to see this trading boost that we saw on the back of the volatility that we've seen over the past couple months? Or do we see a different story start to emerge on some of these tariff concerns, on this uncertainty? Thinking about BNP reporting on Thursday, their loan loss provisions are ticking up very significantly. That hits into profitability. And so they've also got this, large trade finance unit, which, helps facilitate commerce cross-border that is under attack right now.
Okay, what about pharma? So we also have Roche on Thursday. It's it's like a marathon of earnings.
It really is. And so many of these huge themes, right? So with pharma, we've got cross-border. We've got Trump talking about how he wants to bring in sectoral tariffs. Forget the country-specific. We've got these sectoral tariffs looming over European pharma. And, Roche is reporting on Thursday. That's going to be really interesting to see because they have just announced $50 billion in investment in the United States. How do they kind of communicate that message over the course of this earnings call?
We had a great conversation also with Ben Boage of UBS, basically saying that even if President Trump walks back some of the tariffs, it's still going to hurt growth, and therefore it will hurt earnings per share. What are you seeing happen in Europe?
I think that's the concern about the consumer, right? I think that can the consumer, if we think back to L'Oreal, continue to propel some of these, more discretionary companies? If we think about a softening economy, how does that impact banks, for instance? Thinking about BNP, thinking about the fact that rates have just been lowered, that could create an environment where the lending that these businesses, that these banks have been bringing in is softer than it's been over the past few quarters.
All right, so thank you so much to Charlie Wells there with the very latest, of course, on earnings. We'll be watching for Tesla a little bit later on as well. Now, there's a lot going on in the markets. First of all, U.S. stocks set to bounce back from yesterday's losses that were pretty violent. Investors weighing progress, of course, on trade talks, for example, in India, but also a lot of focus on these Tesla upcoming earnings. A couple of other things I need to watch out for is gold actually topping 3,500 for the first time ever. Again, market volatility driving haven flows also into yen. The yen strengthening beyond 140 per dollar for the first time since September. Up next, it's Bloomberg Brief, and this is Bloomberg.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Feeling the pressure, sell America sees stocks, bonds, and the dollar sell off in tandem. Futures attempt to rebound this morning. Finding a scapegoat, President Trump continues to blast Fed Chair Powell's policy. And as analysts warning stack up and sales slump, Tesla report earnings before the bell. So we do attempt to rebound. After maybe what was the quietest sell-off, again, that toxic mix of stocks down, yields up, and a dollar weaker. We're up by more than 1% across the major indices this morning. Relief for the NASDAQ after slipping into yet again a bear market yesterday, down 21% from the highs. The thing that continues to lead us lower, you can see gold at the bottom of your screen at one point hitting 3,500 for the first time on record. It's hit 22 all-time highs so far this year. When it comes to the bond market, it was a sharp steepening of the yield curve yesterday. The 2s, 10s, and 230 slope saw their steepest levels since January of 2020. We're a little changed this morning, but slightly higher on the front end by about 3 basis points, 3.78 there, 4.41 for your 10-year yield, and the dollar at its weakest level since 2023. Let's look at some stocks underneath the surface with your stocks to watch this morning. Here is Bloomberg's Joe Easton. Good morning, Joe. Great to have you back.
Morning, Danny. So Boeing in focus today is the company potentially going to be selling its Jeppesen navigation unit to Thoma Bravo, the private equity company. Now, Bloomberg has previously reported that this business could be worth around $8 billion, so it isn't a small unit by any means, but Boeing shares only up around 0.5% in the pre-market. Then here in Europe, Novo Nordisk absolutely slammed at the open of trading in Copenhagen following that data from Eli Lilly, which showed their weight loss drug, which is a pill, saw users lose around 7% of their body weight in 40 weeks, and that is a huge competition concern for Novo. The Danes had a nice 5-day break for Easter, but that stock getting hit as they come back following the holiday. And then finally, Keep an eye on solar stocks. We are seeing some small moves higher in some of those shares as Trump slams 3,500% tariffs on some of the goods produced out in Asia. I had to read that headline twice when I saw that. And as usual, this is all on the Before the Bell opening wrap on the terminal, written by yours truly today, so have a read of that one.
I'm sorry, Joe, did you say that the Danes get 5 days for Easter?
5 days, yeah, absolutely fantastic. Right. Well, I think I might be moving to Copenhagen
I was
soon.
going to say, you and I will have a word with the bosses and put in our notice to see if we can be moved out there. Joe, thank you so much. Bloomberg's Joe Easton with the stocks to watch. And we have a great hour coming up for you. We're going to be catching up very shortly with Max Kettner of HSBC, and later in the hour, Lori Calvasina of RBC Capital Markets. Now, President Trump has been doubling down, putting the pressure on Fed Chair Jay Powell, posting on Truth Social yesterday, quote, with these costs trending so nicely downward, just what I predicted they would do. There can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates, now, of course, referring to Fed Chair Jay Powell. And equities selling off yesterday in reaction to the pressure. Joining us now is Max Kettner, Chief Multi-Asset Strategist at HSBC. Max, really great to see you this morning. Look, it is a market that had been dictated on the different machinations of trade policy. How do you even begin to price this in? Not necessarily even Trump trying to fire Jay Powell, but just continuing to talk about it.
Yeah, good morning. I think what it does is it really leaves sort of the position indicators, the sentiment indicators, really a bit in flux and a bit in question actually at the moment, because when we look at our framework at the moment, actually the last 3 weeks, it's been sending some buyer signals, but we haven't really followed that. It's been really the first time in, I would say, years that we've not followed our own sentiment and positioning indicators and have argued against any sort of technically driven, at least technically driven rebound, because precisely like you say, you just don't know, right? You don't know whether the next day there's going to be some more volatility coming, something more unexpected. The truth of the matter, I think, is for us, it doesn't really matter what happens next with the tariffs, what happens, you know, what kind of rate is being slammed on country A or country B, how the negotiations will go with Japan or with Canada or the EU. What matters most and what really mattered most in the last few weeks for us is that kind of uncertainty, is the level of elevated uncertainty. Is that truly going to go away? What is the potential that that will completely dissipate? And that, I think, continues to be utterly low, and that keeps really risk assets pretty vulnerable, I think, at this point.
But Max, I mean, we're talking about the next 4 years then, aren't we? If this is the feature of Trump's policy, is this uncertainty, what are we talking about for equities, not just this year, but for the entirety of Trump's term?
No, I don't think so. I mean, number one, we've got the midterms next year, so let's see how those will go. I don't know, but let's see how the midterms will go. Maybe that will change things, for example, number one. Number two, I think there will come some point also in terms of fundamentals and in terms of what is being priced in, where things really will look like, okay, now there's enough pessimism in the price. We're just not at that level yet, right? Everything's good at price. Everything's for sale at some certain price. It's just not that the price is quite right at this level. When we look, for example, at a couple of our fundamental indicators and we compare them with cyclical against defensive equity performance globally at the moment, there is still almost a double-digit gap between those indicators, those fundamentals, and what cyclicals against defensives are pricing. So clearly, you know, there is still too much hope priced into cyclicals. I think once that comes down, once you see a bit more pessimism priced in there, then to us, the price is a bit more right, and then that's really time to go back in.
And what does that look like, Max, to have an appropriate level of pessimism priced in?
Yeah, I think so. The level that we're looking for between the fundamental indicators that we track, sort of the forecast revision, top-down forecast revision and revision momentum, when we plot that against cyclicals, against defensives, at the moment we've got an almost 9 percentage point gap between those two. So once that is closed, right, so once we see perhaps cyclicals underperforming another sort of 8-9 percentage points, I think that's enough pessimism. When we've got, for example, in perhaps already in May, some evidence of the April data, the hard data disappointing. Again, that would be a sign of really, enough weakness already being in the economy and being already in the data. Because so far, let's remember, the narrative, the widespread narrative is really, don't worry, it's all the soft, it's all the survey data, it's just a slowdown, it's not a recession. I think once we do see some evidence that the hard data is indeed slowing, again, that is, I think, enough of a sign of, okay, it's not just a slowdown, we've got to price in more in. Once that a bit more pain is in, I think that's the right price to go back in then.
And Max, you're very much talking about the fundamentals of the economy here, but I wonder if there's a degree, and you even just look at the move higher in yields, that it's been led by real rates, not necessarily break-evens, that the real concern is about less credible policy, means that kind of the huge privilege that the U.S. has in order to run these twin deficits goes away, and the foreign appetite for buying U.S. assets goes away with it. Should there be a concern less about where the economy goes and that sort of flow and that sort of structural shift in how we view American assets?
Yeah, I think we are seeing that to some degree already, right? When we look at the dollar, actually, it is mostly a dollar move. Look at things like Euro Yen or even Euro Swissy, they are not moving nearly as far or are actually flat over the last 2-3 weeks relative to the dollar. So it is largely a dollar move. But again, I think once we see particularly also position indicators, sentiment indicators, a bit too stretched on the dollar side, I think that will also then at least give us a technical rebound in some of the US assets, particularly then also in the dollar, but also in US equities. I think we're going to get, I think, to the point in the next 2-3 months where it's going to get really consensus to be rest of world overweight over the US, and where you'll probably start to see some sort of rebound. Because I totally appreciate, yes, we've got this policy uncertainty, we've got this political uncertainty, but let's remember, why do we buy the US? We buy the US but because the return on equity gap is now 4 times as high compared to the rest of the world than it was 15 years ago. We don't necessarily only buy it because, it's the Republicans or the Democrats in power. No, we buy it because of the earnings power, because of the margin superiority. And I don't think that really is going to go entirely away.
Well, to that point, Max, we're getting into the thick of earnings season. What are you looking out for? Because it's been very uneven as to what companies say about what their future will be and whether they're actually willing to give a forecast or even willing to give just one forecast.
Yeah, I think that's precisely actually what we're looking for. What we are looking for not only is on the top-down side, the first sort of hard data disappointing, but also from the bottom-up side, from the corporate earnings, really corporates telling us either, look, we cannot hold the full-year guidance, we need to cut full-year guidance, and or pulling guidance overall. And that is precisely what we're seeing at the moment, right? We are seeing more and more companies saying, look, we are unable to give you guidance, or they give you some sort of widespread fan charts where you're saying, well, if it's a recession, it's this. If it's not a recession, it's that. So, I think it's this kind of elevated level of uncertainty where really investors then at the end of the earnings season and in 2-3 weeks will say, look, well, what do I do with this? With that level of uncertainty, cyclicals will have to take another beating. Once you've got that, I think then, again, it's time to go back in.
Hey, Max, just quickly before you go, so on a day like today where you do see a rebound and you're calling for no technical rebound is going to be happening, do you want to sell into those moments? Is that what you should be doing?
100%. 100%. I think moments like today, but also the last sort of hour and a half yesterday, they do tell us there is very little panic so far. In fact, when we look at our indicators, real money positioning, long-only sentiment is still pretty elevated, right? So far, it's really been systematic selling, it's been hedge fund selling. Long-onlys, on aggregate, at least on our measures, are still overweight in equities. They've trimmed in credit, both in IG and high-yield credit, but in equities, still overweight. So to me, I think perhaps even retail buying, long-only, still this buying the dip behavior is in there. As long as we've got that, I think any kind of rips, any kind of, or any evidence where really people are buying the dip, you want to use that to trim exposure even further.
Yeah, I go back to my favorite earnings headline of yesterday, of last week, Schwab saying that our clients want to buy the dip and want to buy equities, but are asking for help. Max, thank you so much. HSBC's Max Kettner, always so wonderful and insightful to have you on. Let's get you some other top stories now that are trending on the terminal this morning. Joe Easton mentioned this. The U.S. is imposing tariffs of over 3,500% on solar imports from Cambodia, Vietnam, Malaysia, and Thailand. A years-long investigation found solar manufacturers from those countries were unfairly benefiting from government subsidies that helped them to sell to the U.S. at rates lower than their costs. Harvard has escalated its showdown with the Trump administration. It sued several U.S. agencies and top officials for freezing billions of dollars in federal funding. Lawyers argue that the government unlawfully suspended the funding after it refused to comply with unconstitutional demands to overhaul hiring policies and diversity programs. And Nomura has agreed to buy Macquarie's U.S. and European public asset management business for $1.8 billion. It's Nomura's most significant overseas acquisition since it bought Lehman Brothers in 2008. The all-cash deal allows Nomura to scoop up about $180 billion in client assets, all of this according to a company statement. Coming up, U.S. retailers seek tariff relief. We're going to have more on President Trump's meeting with executives from Walmart, Home Depot, and Target. That's coming up next. Stay tuned to your brief.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. President Trump met with major retailers at the White House on Monday. The executives were seeking tariff reliefs, Target among them putting out this statement. We had a productive meeting with President Trump and our retail peers to discuss the path forward on trade and remain committed to delivering value for American consumers. Joining us for more on this is Bloomberg's Brendan Murray. He heads global trade coverage for us. So we had Walmart, Home Depot, Lowe's, Target, among those included in this meeting with Trump. What do we know, what happened, and whether there was any progress made?
Yeah, so these companies, these retailers are coming to the White House with basically two big problems. The first is on the supply side. With so many countries facing tariff threats from the White House, they're going to have a hard time to continue to import in the quantities that they need to import and still keep their costs low. On the demand side, they're looking at consumer sentiment, business sentiment, and seeing those numbers go down with all the uncertainty that's around there. So these companies would be asking the president to go at a slower pace. Everything all at once is causing a lot of disruption both on the supply side and the demand side for them. As far as what they're going to get, we'll have to wait and see. The president has been pretty adamant that these tariffs, are working, that they're driving countries to the negotiating table, and that inflation isn't a problem as a result. So it'll be interesting to see if that tone changes, that view out of the White House changes after he's heard from these big retailers, Target, Home Depot, and a few others.
Well, elsewhere, Trump was posting on Truth Social yesterday saying tariffs are going well, everybody wants to negotiate. But Brendan, at this point, we have no agreement with Japan, nothing with Mexico, nothing really to show. Is there any movement anywhere that we've seen with country negotiations away from these specific companies?
We've seen several countries line up. We had J.D. Vance in India this week. They talked about how things went very well with those discussions. We have South Korea coming to Washington later this week. There are other countries like Thailand that say they want to make deals too. So it's one thing to say you want to make a deal. It's another to sit down and actually do it. It takes a long time. There are a lot of details. There are a lot of lawyers sitting around the room. And so it depends on what you mean by deal as when you ask how quickly they're going to come about. But you can pretty much bet that this is going to take a long time. It's not going to take days or weeks. These kinds of commercial arrangements, have a lot of fine print to them, and they don't get done overnight.
Yeah, fair enough. I mean, the Trump administration had said we'd get 90 deals in 90 days. Of course, as you said, J.D. Vance in India, we are expecting a speech from him from Jaipur later in the hour. Brendan, thank you so much for joining. A lot to keep track of. There is the vice president there meeting with the prime minister. Thank you so much, Brendan Murray from our trade team. Coming up on the show, we're going to take a look at what else is making headlines around the world. We're also going to preview Tesla's earnings out. Those come before the bell. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
This is your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what is on the front pages this morning. First up, coming on the Wall Street Journal, they're leading with the Trump rout taking historic dimensions. I know some people might be angry about this, but their headline does include the Dow headed for the worst April since the Great Depression. The index shed almost 1,000 points on Monday, which me just saying that might also make some people upset. Anyway, the Dow is doing things. Next up, the Financial Times running about gold. This is their lead, hitting 3,500 for the first time. The precious metal has risen over 30% this year. It's benefited from a rush to haven assets as President Trump rattles markets with tariffs and that sustained attack on Fed Chair Powell, that adding the extra leg higher. Finally, the front page of the New York Times leads with the final days of Pope Francis. The late Pope had seemed intent on returning to pastoral duties and emphasized the themes that defined his papacy, such as defending migrants and people on the margins of society. So later this evening, Tesla will be kicking off the big tech and auto earnings. The reports after the bell. Shares of the automaker, they are up slightly, up 0.6% in the pre-market trade ahead of its first quarter numbers later today, but it fell yesterday. The company faces questions about multiple things, about its sales volumes, about autonomous driving, tariffs, and of course, CEO Elon Musk's ongoing role at the White House. Joining us is Bloomberg's Craig Trudell, who leads our global autos coverage. Craig, great to see you. What are you going to be looking out for in the earnings today?
I think Musk really has a sort of tall task on hand today, because he's going to have to sort of really do his darndest to have, the bright, shiny objects to sort of distract from the numbers. Because, when you look at what's expected revenue-wise, earnings per share, the consensus has just dropped like a stone on these counts. The expectations are really depressed, and I think there's a real concern too about just the second quarter as well. How much can we expect Tesla to grow volumes when all it has really to offer is a refreshed Model Y, and the Cybertruck is really letting folks down. The Model the Model 3 refresh did not pan out particularly well, and the rest of the lineup is quite dated. So on top of the issues with Musk and the concerns about, what he's doing to the brand and what he's doing in Washington, just real strategic issues with the company and when the company is going to have reinforcements in terms of fresh product.
In terms of that fresh product, we had that Reuters story back on Friday, Craig, about a delay to an affordable model. How important is it for sales that Tesla bring a more affordable Y to the market?
I think, especially in a market like China, where, Tesla is really sort of, getting beat soundly by BYD. A lot of that market is much more competitive at lower price points, where you see a lot more volume. And, Tesla can try to play the premium game, but the question, of course, is, what can they offer on top of what you can get for, say, a BYD or a Xiaomi, and to sort of justify the additional price. And I think you're seeing real sort of strain in terms of Tesla's ability to keep its sales volumes up when you have so much more competition with fresher product to work with. You also, I think, in the U.S. Have much more to choose from than you did a few years ago. Tesla still has a sort of stranglehold on the EV segment. But, you also have consumers who aren't necessarily, going electric in droves, and some slowing down of the momentum, as the rest of the industry really, goes into that segment. So it's a segment that isn't growing like it used to, and Tesla's no longer sort of got the claim on it that it used to have.
Yeah, will be really interesting to also hear just the kind of questions that Musk gets in terms of, are you going to take a backseat in Doge and re-engage with Tesla? Craig, thank you so much for your help, for your coverage. I'm sure we're going to catch up tomorrow to do a postmortem of those earnings. Craig Trudell there, covering the latest with Tesla. Again, those results coming after the bell. Coming up, RBC's Lori Calvasina says recession pricing could drag the S&P as low as 4,200. She'll join us coming up soon.
we're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Bloomberg brings you breaking news 24 hours a day, powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Feeling the pressure, Sell America sees stocks, bonds, and the dollar sell off in tandem. Futures attempt a rebound this morning. Finding a scapegoat, President Trump continues to blast Fed Chair Powell's policy. And as analyst warnings stack up and sales slump, Tesla will report earnings after the bell. So your markets this morning, we do attempt to come back after what was a very quiet sell-off yesterday. Again, it was that toxic mix of stocks down, yields up, dollar weaker, but we're up more than 1% across the indices this morning. Your S&P 500 futures session up 1%. Welcome news for the NASDAQ 100, which has fallen 21% from its peak back in that bear market territory. By the way, gold at one point hitting 3,500 for the first time has hit 22 all-time highs so far this year. When it comes to yields, those also taking a breather, but still under pressure on the front end, though it was curve steepening for much of yesterday. 2s, 10s, and 2s, 30s. Slopes reaching their steepest level since January of 22. We are at 378 for your 2-year yield, 440 for your 10-year yield, with the dollar trading at the weakest level since 2023. Let's take a look at some stocks underneath the surface this morning. With that is Bloomberg's Joe Easton. Joe, good morning.
Hey, Danny. So we've got Boeing in our sights today as the company said to be close to selling its Jeppesen navigation unit. That could potentially be worth around $8 billion. And we're seeing that stock edging up, only very slightly though, up around 0.4% today. Then here in Europe, the big action has been in Novo Nordisk. The shares absolutely slammed as Denmark comes back from a 5-day holiday. We saw that stock dropping around 10% at the open of trading. That's after Eli Lilly's drug showed that patients lost around 7% of their body weight, causing some competition concerns. That is an oral pill rather than an injection, so there's only going to be one winner over which one that you would rather take. So that stock hit hard. Then we've got solar stocks also on the agenda as well. Trump slapping 3,500% tariffs on some solar imports from some Asian countries. I had to do a double take on that headline when I saw that, but it is 3,500 in terms of the tariffs. Boosting some stocks today, including First Solar, that one up around 7% at the open. But also, of course, we're looking ahead to those Tesla numbers coming up after the close of trading later today. Danny?
Yeah, Tesla down more than 40% year to date, so slightly higher this morning. Joe, thank you so much. Bloomberg's Joe Easton with some stock movers. RBC's Lori Calvasina has been weighing in on the potential for a further stock drawdown, writing this morning, quote, "We don't believe recession is a foregone conclusion, but have been pointing out that a tier 3 drawdown or recession pricing could reasonably expected to take the index down to the 4,200 to 4,500 range on an interim basis. For now, we stick with our 5,550 year-end 2025 S&P 500 price target." I'm pleased to say that Lori joins us now. She's head of U.S. equity strategy at RBC. So, Lori, we're not in recession pricing yet, but is there signal in just how fragile the market has been, even if we're not at those lows that you point out?
I think that's fair. And what's interesting is if you look at the AAII survey, we're at GFC lows, 2022 lows, 1991 recession lows. So, you know, pretty awful kind of levels. And you tend to get stuck at those levels for a while. But institutional investor positioning, if you look at this weekly CFTC data, is maybe like third inning in terms of its deterioration. So there's been some de-risking, but not a plunge. And I think that's where you sort of capture the idea of fragility, that there is some, you know, sort of downside in the market, even though on the one hand people feel awful. The position data is not really telling us that things are washed out yet.
Well, it's interesting you say that because we had a conversation with JP Morgan Private Bank yesterday. We're talking with Max Kettner this morning, and both kind of said this idea that people have been looking for opportunities to buy. And it's this buy the dip mentality that has been so ingrained in so many investors. Does something change that?
So, look, I think we have these 4 tiers of fear that we talk about. It's kind of like choose your own adventure as the news flow evolves.
Sounds like a horror movie, by the way, Lori.
A little bit. I will say I scared my husband, like when after I published this and walked him through it, which was not my intention, because, you know, what I told him was this was sort of helping you understand when things get really bad, what levels you want to be thinking about buying at, right? Understanding what the downside levels are and kind of the natural kind of break points, I think is actually a comforting thought, maybe not to him, but was to me. But at any rate, you know, we're sort of in this growth scare phase, which is similar to the 2010, 2011, 2015, 16, and 2018 drawdowns, where there was real fear of a recession or a big systemic crisis, but it did end up happening, right? It was a near miss. That's what we're pricing in right now. So the market is clinging to some hope that we can avoid a big crisis and that we can avoid a recession. Recession pricing, you know, that's pretty easy, 27, 32 type %. Big crisis tends to be you lose half the market value. And, you know, those are big, scary numbers, but I do think what we see over time is that even in those tier 4 periods, you do have longer term buying opportunities. And when we have sentiment that is so negative and so, you know, kind of despair is the word that I keep coming up with, not panic. It doesn't feel like panic, but we do see that despair seeping in, and you have to remember that things do tend to turn around.
But in the past, when things have turned around, it's because you're getting a recession, you get the federal government stepping in with some loosening, you get QE to infinity maybe. But do we need to think about this time as being different? Because we're talking about a reordering of global trade. We're talking about concerns of Fed independence. We're talking about actual structural shifts in the makeup of the American economy and markets. So could this time be different?
I think it could. And we've had some investors who have said, look back to that period of the early 2000s as maybe a potential template. And I always joke that this is a terrible one for any kind of modeling because we essentially had this triple bottom in the S&P in 01, 02, 03. The actual technical bottom was late 02. But it was a really longer term period of malaise. And we had sort of one thing after another: tech bubble implosion, recession, 9/11. We had, you know, a lot of regulatory changes on Wall Street and questions about how investment research was being done, and then the Iraq War. I mean, there was all kinds of stuff that hit. And what you actually saw happen, though, was a significant rotation. Remember, value really started to outperform and had a big heyday that lasted into the financial crisis. I mean, that seems almost like anathema right now. There was once a period in time when growth stocks didn't lead.
Right.
And so to me, just that concept of rotation, we're seeing the U.S. kind of break down, people finally starting to take a look at other geographies. That's one echo that I do hear of that 01, 02, 03 time period.
Could it be value resurging too if we get leadership on the upside from somewhere?
I think it's, you know, to me, the geographical question is more interesting. I sort of struggle with this growth value debate in the U.S. because on the one hand, we know the growth stocks are overheated. We know that those earnings growth expectations are decelerating. But for value to really work, you typically need a hot economy, and everything that seems to be hitting the market and pushing people out of the U.S. makes me think we're set up for kind of a sluggish economy for a while. So I'm really struggling with that, kind of idea of shifting into value. The geographical rotation makes more sense to me.
And we're getting some clues into what companies are thinking about and how they're thinking about it. And for a lot of them, it feels like we have no idea. Here are various scenarios, or here's no scenario. We're not sure what's going to happen. I know you and your team are really, really good at looking through these various earnings statements. Are there any takeaways you've had so far? I know it's mostly been the banks so far.
Yeah, and to be honest, like last week was all about the banks, a little smattering of other stuff. Previous to that, we were actually reading conference transcripts in addition to earnings transcripts across the whole Russell 3000. And I think that idea of uncertainty, it's out there, right? I mean, you're having companies actually, I don't want to beat them up for saying they don't know. I think that's a valid response in here, and I applaud them for talking. I think that over the last couple weeks, we've finally gotten a lot more detail about what's going on and how they're thinking about their outlooks, and companies with tariff exposure are finally starting to really disclose some of those exposures, even though they may not be giving us, kind of the neat and tidy bow with, how it all bakes into guidance. I'm okay with that. The street can do that work to figure out the impact if they give us sort of the raw materials by which to go out and do the analysis. So that's my number one takeaway. So there's just more discussion, and that's really, really healthy in here. I think the other thing, I've noticed from the banks last week, and I sort of chuckled. I'm an equity research analyst, right? And I saw a couple of these big banks giving some shout outs to their equity research department. So I appreciate that on behalf of the sell side. But they were referring to this idea, and I think I've sort of settled into this as well, that we know that the adverse impacts are going to be there on growth and inflation, pushing growth down, pushing inflation up. Can we quite call a recession? It's not clear to me. People were so adamant we were going to have a recession back in 2022 and we didn't. Are we sort of setting up for something similar this time around? So I thought that they were sort of dialing down the temperature a little bit on the recession risk, which I think is appropriate at this point. I think the banks were really interesting in that they're like, look, we're indirectly impacted by tariffs, but we're going out and we're talking to all our customers and trying to figure out what's going on. One bank said, I forget how many companies they'd talked to, but they said nobody brought up layoffs. That's a really interesting, helpful data point. But what we were seeing is, some of these companies were saying, look, our companies are going to have to attack this through pricing. They are going to have to defend their margins. And we are seeing a pause on things like CapEx and M&A and activity in general. So it's a really, really messy situation. And I commend the banks that came out last week. I thought they gave a lot of really good, important detail.
I do wonder for the tech players, because one of the kind of booming animal spirits that we had to start the year in last year was this immense amount of CapEx coming out of big tech, that they're going to be spending on AI, that they need data centers. You have Wells Fargo reporting this morning that it looks like you might have Amazon pulling back on some of their data centers. Does that CapEx also bleed into the tech players? And what does that mean for what was a pillar of the bull market?
I think it's TBD. Look, I will say, I feel like I haven't been reading all that much about AI lately, which is interesting. We have some transcript tracking charts, and I think the AI conversation is actually off peak, like still, up there, but has come down.
Which, by the way, is crazy because it was all we were talking about not that long ago.
Right. I will tell you, every macro discussion, by the way, in last week's earnings calls was tariff, tariff, tariff. There was really no difference between the two, which made my job a little bit easier. But look, I do think that as companies are evaluating business decisions and investment decisions, everything is on the table, right? So we're going to have to keep an eye on that. This is more of a stale data point, but last year when we would sort of look through companies and their AI commentary, if you put aside the big tech players who are really experts and knew what they were doing, kind of everybody else, my team would sort of laugh because we felt like we were getting like all these, we called it small potatoes, like how many, text summaries and chatbots are companies going to talk about. Things for AI to really be impactful, it's got to progress beyond that. So is some of that going to be cut back on? We'll see. But it's something we can certainly keep an eye on.
I got to say, it feels like a different world than 4 months ago. Lori, so great to have you on. Thank you for helping us navigate it. It's always such a pleasure to have you on the show. That is Lori Calvasina of RBC Capital Markets. Okay, let's get you some other top stories that are trending on the terminal this morning. The U.S. is imposing tariffs of over 3,500% on solar imports from Cambodia, Vietnam, Malaysia, and Thailand. A year-long investigation found that solar manufacturers from the countries were unfairly benefiting from government subsidies that helped them sell to the U.S. at rates lower than their costs. And Nomura agreeing to buy Macquarie's U.S. and European public asset management business. The price tag on that is $1.8 billion. It's Nomura's most significant overseas acquisition since it bought Lehman Brothers in 2008. The all-cash deal will allow the bank to scoop up about $180 billion in client assets. All of that according to a company statement. Harvard is escalating its showdown with the Trump administration. It sued several U.S. agencies and top officials for freezing billions of dollars in federal funding. Lawyers argue that the government unlawfully suspended the funding after it refused to comply with unconstitutional demands to overhaul hiring policies and diversity programs. Coming up, Amazon eases off the AI spending, as we were just discussing, pausing some data center leases. We're going to have more on tech next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's your Bloomberg Brief. Danny Berger in New York here. Now, we are watching shares of NVIDIA and Amazon this morning, but they are rebounding after an ugly session for tech yesterday. There's also additional news that Amazon's web service business is pausing some data center leases according to Wells Fargo Securities. Amazon could potentially be following Microsoft in reassessing spending on AI and cloud computed-related investments. For more on this, we are joined by Bloomberg's Tom McKenzie. Tom, it is the fear after this narrative led the bull market. Does it look like some of these big players are pulling back on AI data centers and CapEx?
This follows the story, doesn't it, from Microsoft around their pause, around some data center leasing and build out, particularly in Europe. And now we have this note, as you say, from Wells Fargo Securities saying that they are seeing similar pauses now coming through from Amazon. And you're seeing as well investor sensitivity to this story. You're seeing some of the electrification stocks, some of the energy stocks in Europe falling on the back of this news. Even as you say, pre-market Amazon is up. So what we know at this point is, according to this analyst at Wells Fargo, they have paused some of these leases for data centers. We have heard from a senior vice president at Amazon from their global data center putting out a message on LinkedIn saying that actually they are seeing no fundamental change. And then, in fact, they continue to see strong demand, particularly for Gen AI and the data centers they provide to underscore that shift. The analysts say they're not sure whether this is a concern or whether this is just some of these hyperscalers basically adjusting to the environment. But what they do say in this note is that it does seem that these hyperscalers are becoming more discerning about their spend and about the leasing around some of these data centers. Also as well, following the comments from Joe Tsai of Alibaba saying that he thinks there could be a bubble when it comes to the build out of data centers. Again, the vice president of the global data center at Amazon saying we are seeing no fundamental change. But it does raise the question, doesn't it, in an environment of DeepSeek, but also of those macro challenges around what could happen to labor markets and, of course, supply chains as a result of tariffs, what this means for the data center build out going forward and the sensitivity investors have to that exposure.
Tom, just while we're talking about the hyperscalers, on a very different note, we have Google facing off the DOJ in a trial starting yesterday over their search monopoly. Do we have any updates as to what the outcome of this might look like for the search giant?
Yeah, so this is a case that involves the judge who originally ruled in November of last year that Google had violated antitrust laws. This is about that judge looking now at potential remedies. And interestingly, the Department of Justice officials have come out and said that a forced sale of the Chrome browser should be part of that potential remedy. We also learned that from January of this year, despite previously being found twice to have violated antitrust rules in similar cases, since January of this year, Alphabet have been paying Samsung to host their Gemini generative AI app on Samsung phones. We don't know how much, but we've heard that it's a considerable amount. These are monthly payments, apparently, to Samsung. This is something that Alphabet admitted, or at least mentioned, in the court case. We'll see what the outcome ultimately is, but previously you've had examples in terms of just how much Alphabet may be paying. They've paid, for example, Samsung previously between 2020 and 2023 about $8 billion to host some of their apps on Samsung phones. So it could be a considerable amount. We know the DOJ continues to push for some kind of breakup. And again, forced sale of Chrome web browser is one remedy they are looking at. So this is a crucial case for Alphabet. And it's a crucial case, of course, for their competitors as well, the likes of Microsoft, but also OpenAI.
Okay, Tom, thank you very much. That is Bloomberg's Tom McKenzie. Now, elsewhere in politics, Vice President J.D. Vance is in India for a 4-day visit. You can see him there. He is speaking in Jaipur. He held trade talks with the Prime Minister Narendra Modi in New Delhi on Monday. The White House says that the U.S. has made significant progress towards a bilateral deal following those trade talks. We'll listen into the vice president shortly, but first, let's bring in Bloomberg News desk editor Uni Krishnan for more. Uni, any sign of a deal yet between the U.S. and India?
Thanks and good morning. Yeah, I mean, I guess both sides, both White House and Prime Minister Narendra Modi's office have said that, they've made tremendous progress. Vice President J.D. Vance's visit underscores the level of commitment both sides have shown for a trade deal. And it is also to accelerate the progress of talks so that they meet the 90-day deadline. And it seems it's headed in a much positive direction.
So, by the way, J.D. Vance, again, speaking there in Jaipur after meeting with the Prime Minister, Narendra Modi, at the moment just talking about it's the first visit to his wife's birthplace, so not talking about policy yet, just pleasantries. Uni, but they have 90 days to get deals done, and both sides are saying that there are more progress. There are complicated links between the two countries. What sort of timeline is realistic?
I mean, I guess given Vice President's visit, I guess we do foresee a deal happening pretty quickly. I mean, it's a different matter. It'll happen within the 90-day deadline, and I guess the Indian side has really warmed up to what Prime Minister Narendra Modi during Prime Minister Narendra Modi's visit to the United States, where President Trump had reiterated that he wanted greater market access to farm products or for the U.S. farm products, and that seems to be definitely something that's going to happen under the trade deal, and also India's high prohibitive tariffs as far as electric vehicles were concerned. Several other aspects like high duties on heavy-duty motorcycles, especially Harley-Davidson, those have been addressed in the budget that was unveiled in India in February. So I presume we're really looking realistically towards a sort of a summit-level talk between President Trump and Prime Minister Modi in the immediate future for a trade deal.
Okay, Uni, thank you very much. Uni Krishnan in talking to us about J.D. Vance in Jaipur, who just says that Trump wants India to grow. Let's listen in to the vice president.
One that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world. And as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them, our capacity to make things, from furniture, appliances, and even weapons of war. We traded hard power for soft power, because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat, after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner, while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard. They taught me to study hard. And they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steelmaker at the local mill. And I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore...
Vice President J.D. Vance speaking in India, talking about some of his background, relating it to that of India, but started out saying that the U.S. and President Trump wants a strong India, wants India to grow, and saying that it wouldn't lecture it with how to do so. So we'll keep an eye on any headlines coming from the Vice President in India there as he tours the region. Let's get a quick check on markets as we head towards the end of the hour. You're looking at stocks attempting to rebound after a tough day yesterday of losses more than 2 1/3% for the S&P. Max Kettner of HSBC says he'd be selling into any strength like that of today. The Bloomberg Dollar Index also tries to rebound, trading around its weakest level since 2023 as yields take a breather. They have been moving higher. Again, that toxic mix of stocks, dollar, and yields down. All right, that is it for Bloomberg Brief. Surveillance coming up next. You're watching Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is an attack on the independence of the Fed.
If there is a disruption to the Fed's independence, we are on a slippery slope.
One of the keys to the U.S. financial market is the independence of the Fed.
It's so obvious, the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible.
The end result is that we're all asking huge, major tectonic shift questions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday with the pressure building on Fed Chair Jay Powell, as President Trump warns the economy could slow unless, quote, Mr. Too Late cuts interest rates, the tension leading to a rethink on Wall Street. Barclays writing the live prospect of reduced Fed independence unlocks dollar risk too large to ignore. The dollar moves already too large to ignore. The greenback heading towards its biggest monthly decline since 2009, helping to push gold to another all-time high.
And it's come so much quicker than so many people think. A number of commodities analysts have said that they really had to bring forward their expectations and their price targets on gold. Look, there's a real question about how much what we're seeing in markets is due to the belief that truly Jay Powell will be removed from the Fed chair position. But there's another belief, which is that policy uncertainty in the United States is undermining dollar-denominated assets, regardless of what happens. And it doesn't really have to do with Fed Chair Jay Powell as much as a constant threat to some of the bedrocks that people have relied on.
We've seen that in the price action of the last 24 hours. Bond yields higher, the dollar weaker, gold a whole lot stronger over the year so far. Gold has absolutely ripped. And a lack of clarity about policy in the United States at the epicenter of some of those moves.
Lack of clarity when it comes to tariffs. I've seen a number of notes, most notably this morning from Lori Calvasina of RBC saying the fog of tariffs. How many analysts are putting out the fog of tariffs? On top of that now, they have the fog of who is going to be the Fed chair. Right now, it is Jay Powell, but Trump continues to double down, calling him Mr. Too Late, saying not just cut rates, but I don't think you're right person for the job. This morning, Jonathan, Wall Street Journal editorial board, smart presidents may pay attention to market signals and adapt. The adaptation now would be to negotiate a quick end to the tariff barrage, claim some trade deal victories, and call it a day.
Let's pick up on one of those lines. The president's doubling down. The risk is the Fed digs in. And this is a point that B. Mosey and Lincoln made just yesterday. The Fed digs in to protect institutional credibility and doesn't move when maybe they should move.
Yeah, and this also goes to the question of exactly what the role is going to be, not just of the Fed chair, but everybody else, right? Have people dug in on the Fed to try to say, look, we're not going to cover your mistakes. It is not our problem. There also, though, is the uncertainty of if the Fed were to move at a time where the move has come in real rates, not break-even rates, not the front end, how much do do they create a liability for themselves that they can't put back in the bottle if, say, there are deals reached, which is the expectation? So there is a question of the political perception in addition to the monetary reality, which is very unclear.
There's a little bit of stability in the tape this morning, at least. Equity futures positive by 1% on the S&P 500. In the bond market, the 10-year just about unchanged. The 30-year yield down almost a single basis point. Coming up through the next 60 minutes, Brian Levitt of Invesco following a rough day on Wall Street. Brian Gardner of Stifel, as the president says tariff negotiations are going well. And Krishna Gua of Evercore as the pressure builds on Fed Chair Jay Powell. We begin this hour with stocks bouncing back. Brian Levitt of Invesco writing, markets have struggled as investors assess ongoing changes to the nation's policy approach. It's difficult to put plans in place without knowing the rules. Brian joins us now for more. Brian, good morning. Good to see you.
Good morning. Good to see you.
You're usually constructive, bullish. Does this feel different to you?
It does feel different to me. I mean, the reason that I'm usually constructive and bullish is in most years things get better relative to expectations. And this is a year where things are getting worse relative to expectations, and policy uncertainties are mounting on top of each other. Now, it's interesting, Jonathan. People usually ask me when I'm so bullish, well, when do you get bearish? When does the volatility come? When does the drawdown come? And invariably throughout my career, I said these things don't emerge out of nowhere. They're almost always the result of policy uncertainty. And we're sitting here now. Typically, when we have policy uncertainty, you can start to see things that'll get you to sense that policy direction is going to change. And right now, we're really more on the whims of the White House and waiting to see ultimately what that's going to look like. So it's hard for markets to get a footing in that type of an environment.
It's leading to a rebalancing away from dollar-denominated assets. We've seen that through the whole of the year so far. Is it anything more nefarious than that, a rebalancing following a decade-plus series of years of outperformance for U.S. assets?
I would say right now it's a rebalancing. I mean, if you think about where the dollar was incredibly strong, and money's going to flow to where it's treated best, right? And so rates were above the major trading partners in the U.S., growth was better. So no surprise that the dollar was as strong. It was expected that over time, as U.S. exceptionalism started to narrow with the rest of the world, that the dollar could moderate some. But we were hoping it was going to come from better growth outside of the United States. To see it happening amid policy uncertainty, that's more problematic. Now, I wouldn't say it's the beginning of a collapse in the dollar or the end of the reserve currency. It's a move that a lot of people had expected, but really coming from a direction that's different. Most of us thought it would be a broadening out, a recovery in the major parts of the world as central banks started to ease, particularly in Europe and in the UK.
If it weren't for the policy uncertainty, you sound unabashedly bullish. You said at one point, I'm confident that the U.S. economy is strong enough to adjust to different policies. Yeah. It's just the uncertainty therein. So what does being bearish for Brian Levitt, a FOMO kind of guy, look like?
Well, the setup coming into the year was good, right? We had a strong economy. We had stable inflation, but at the upper end of the comfort zone. So you add that together, that's good nominal growth, which is supportive for corporate profitability. So the setup was good. The challenge that we have now is we've seen a valuation adjustment largely in the more expensive parts of the market as a result of the policy uncertainty. We don't have a market that's set up for recession if you look at it in credit spreads or you look at it in equity valuations. So my concern, what does bearish look like? My concern is that the longer the policy uncertainty persists, the bigger the hit to economic activity. You'd have to bring down earnings expectations, but at the same time, as we threaten Fed independence, we're seeing interest rates creep up, which could be a hit to valuation. So we're down 18, 19% peak to trough, most of that driven by the largest names, but multiples are still elevated. So you would have to see that come down, assuming the policy uncertainty persists. I mean, we've joked, it's hard to even plan for a podcast right now. How do you plan to build a factory, right?
Amen to that. There's this question about how long this can persist before you get certainty of the uncertainty. You get certainty about some of the ramifications from that policy lack of clarity. Do you have a time frame in mind where suddenly the 6% drawdown on the S&P 500 since Independence Day or Liberation Day doesn't really look like it's adequate to compensate for some of the actual economic damage?
Yeah, I think we're starting to see that. I mean, the longer this persists without trade deals, the longer we're concerned about whether the Federal Reserve could actually respond. I mean, for 40 years, the Federal Reserve has been able to respond to weakness in the economy. The longer that goes on, the bigger the challenges will persist. Now, what's the more positive side of this? How can we bring this back to intermediate or longer-term investors? The reality is these things can change on a dime. You saw it on April 9th, where we got a 90-day pause and you had the third best or fourth best day in the market since 1957. You miss those days, it's going to be have a significant impact on your portfolio. So what do you do about it? The way I like to think about it is it's critical to try and bring down the valuation of the overall portfolio. So outside of the United States, more value-oriented stocks can help. The nice thing about that is in a recovery, those parts of the market should do well also. So I think that's the way we handle it. We hedge against risks. You talk about non-dollar exposure. We see what's happening with gold, but we got to be careful not to think of it as an existential long-term crisis. Ultimately, I think we're at peak policy uncertainty, and then
are we? I've heard that so many times. Isn't uncertainty part of Trump's grand plan of being a maximalist negotiator?
Well, I think we thought that, and you could be right, but I think we thought that in 2018, where it felt like we were never going to come to the other side of it. We got a 90-day trade pause, Fed backed off their tightening cycle. And
this feels different, though, Brian. This feels like this administration is pushing for a massive realignment across several dimensions. Do you not get a sense of that? Now, you can sit here and say that maybe they won't be successful. Perhaps they'll give up. But isn't that the objective?
Well, we don't know, because we've seen fits and starts with it. So we've heard from some administration officials that that is the goal, and then we've seen the president adjust course on it. So, you know, there's still hope that there's going to be negotiated deals out of this. But yeah, again,
they're pushing back repeatedly against the whole post-war system.
Yeah.
Read what Stephen Myron is putting out there, the chair of the economic advisors. Now, again, you can sit here and say, I don't believe them. But that's what they're saying on the record. And at times I feel like we're sitting around the table talking about the weather at a time when they're trying to rethink the whole solar system. Right. And I think that affects you directly. For a long, long time, dollar assets were the epicenter of the universe. There was this structural bid into them every single year. And the people that were just saying up and to the right weren't really putting their finger on why that was happening. This administration is pushing back against that. Should we have to rethink what all of that means for tactical asset allocation, the dollar's role in the portfolio, what treasuries offer me? Will they provide that ballast going forward if I have to rethink that and go somewhere else?
Yeah, I mean, we've become way overexposed to the United States as global investors, and some of that was by design, American exceptionalism. Some of that was just by market moves. And you know, there's these statistics where more people were buying Bitcoin than the IFA index ETF over the last 10 years, right? So we understand that we were offsides with regards to that. So yeah, I do think it is time to rethink portfolios, to think about bringing down the overall value of the portfolio. You know, I don't expect, you know, I think bond vigilantes still exist. I'm with James Carville. I still think they're going to intimidate everybody. I still think ultimately we're going to have to respond to higher interest rates. And so I don't see rates getting way out ahead. But yeah, it's a rethink, and investors should reallocate appropriately.
You hit it. You think the bond market is still the biggest constraint over any possible ambitions down in Washington?
We saw it on April 9th. I mean, I took off for Los Angeles in the morning, concerned that the bond market was showing significant cracks. Thank God for in-flight Wi-Fi, because I was able to get the alert that we had a 90-day pause. Otherwise, I would have wasted 5 hours of work. So we see it. You know, Carville said, I'd like to come back as the bond market so I can intimidate everyone. I still kind of question that. I mean, I'd still want to be like Springsteen or Tom Brady or somebody like that. But he wants to come back and intimidate everybody. That's precisely what the bond market does. And right now you've got vigilantes on all sides. I mean, it's very rare to have equity market, bond market, and currency vigilantes on all sides. And, you know, ultimately, I think the policymakers are going to respond to it.
The market's pushing back. Brian, it's good to see you.
It's good to see you,
as always.
too.
Thank you, sir. Brian Levitt there of Invesco. The bond market's settling down. The 10-year yield just about unchanged today, 441 on a 30-year maturity. 490 is the yield at the moment. With an update on stories elsewhere, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. Pope Francis' funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. A viewing of his body will begin this Wednesday in St. Peter's Basilica. President Donald Trump said he and the First Lady would attend the funeral, embarking on the first foreign trip of his second term to honor the late spiritual leader. Elsewhere, President Trump says that U.S. Defense Secretary Pete Hegseth is doing a great job despite what appears to be attacks from disgruntled employees. Hegseth is facing a staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecured chat group. President Trump also met with some of the nation's major retailers at the White House as executives sought relief from tariffs. Bloomberg reporting that the meeting included representatives from Walmart, Home Depot, Lowe's, and Target. Spokespeople from both Walmart and Target called the meeting productive. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, Trump's confidence in the economy.
The economy is very good. We don't have inflation. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
That conversation up next with Brian Gardner of Stifel, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equity futures bouncing back by 0.9% on the S&P 500. Stuart Kaiser of Citi. The path of least resistance is lower. Yesterday we were lower by more than 2%. Doesn't even make it into the top 3 for the month. Down more than 2%. Desensitized to these major moves we're seeing in the equity market. Major moves lower over the last month. The Nasdaq bouncing back by, let's call it 1% this morning. Under surveillance this morning, Trump's confidence in the U.S. economy.
We're going to ultimately have a deal with anyone. The economy is very good. We don't have inflation. Energy's down at the lowest it's been in years. We hit actually $1.98 recently in a couple of states. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
So here's the latest this morning. President Trump saying tariff negotiations are going well as he continues attacking Fed Chair Jay Powell and calling for lower interest rates. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, doubling down on the Fed Chair and also coming out repeatedly suggesting we're getting closer and closer to trade deals. How close are we?
Yeah, John, good morning. Well, that's one of the big questions here. We are seeing some positive signs, including that Treasury Secretary Scott Bessent is expected to meet with his Japanese counterpart here in Washington later this week. We also got a significant readout after J.D. Vance met with Indian Prime Minister Modi just yesterday, saying that they have confirmed a finalized roadmap for a deal. It's really, though, still leading to a lot of uncertainty here, as Jerome Powell indicates that the Fed will remain in wait-and-see mode amid the tariff fallout. And President Trump really ramping up his attacks, going even further yesterday to suggest that the U.S. economy may slow if the Fed doesn't cut interest rates and fast. Mark Zandi of Moody's Analytics was on Bloomberg television yesterday, suggesting that the Fed chair's job has never been harder because the central bank is caught between a rock and a hard place when it comes to inflation and weaker growth, not to mention all these uncertainties about a trade deal, because we know it takes time to clinch them, let alone in 90 days. John, the latest reporting is that we could expect potentially a court case to be decided this week that could have far-ranging impacts on the Fed as the Trump administration seeks to overturn legal precedent as it ramps up its attacks on Jerome Powell.
Tyler, when it comes to the trade deals, is there a sense from U.S. trading partners that they're walking away from meetings understanding exactly what the U.S. wants out of these agreements?
Yeah, Anne-Marie, it depends on which trading partner. There is still a lot of ambiguity here, even as Bloomberg News reports that the administration is getting ready to push our trade partners particularly hard when it comes to what concessions they can make on their own trade with China. But take Japan, for example, considering that country has been given priorities in these talks. We are watching a few threads here as President Trump really doubles down that those non-tariff barriers are going to be incredibly important in these conversations going forward. Japan, for example, has already pledged that it will boost U.S. LNG imports, but we know this White House would like to also see them make firmer commitments when it comes to agricultural imports as well. And President Trump really doubling down on the idea that he would like to see a lowering in standards when it comes to U.S. auto imports into the country, alleging that stricter standards has made it more difficult for U.S. automakers to access that market. So we're really going to have to see moving forward here which of these countries can clinch that trade deal, but it's clear that the administration wants to focus on those non-tariff barriers.
Tyler, thank you. Tyler Kendall down in Washington. Much more from Tyler later on this morning. Joining us now to extend the conversation, Brian Gardner of Stifel. Brian, welcome to the program, sir, and good morning to you. America has demands. Is it clear to American trade partners what those demands are?
No, I don't think so. I mean, I guess it depends on the country, Jonathan, and good morning. I think a lot of the demands is trying to isolate China, but each country, each individual country has its own trading relationship with China. And so I think that's actually one of the confounding things about the whole Trump strategy has been that it was us against everybody else instead of picking off China and getting certain deals in place ahead of time to make it easier to isolate China in a broader policy agenda.
Brian, these are the 90-day reciprocal tariffs in terms of this pause that the administration is trying to get a deal done before those 90 days are up. But what about the sectoral tariffs? When are those going to be announced?
Great question. Trump, the president, signaled that more tariffs were coming, pharmaceuticals. He signaled that in early April. He said it was coming soon. I would think over the next couple of weeks, but I don't have a specific date in mind. But they are coming. I mean, one thing I think investors should keep in mind is anytime President Trump has said he's going to do something, he follows through on it. So if he says that tariffs on pharmaceuticals are coming soon, they're coming soon.
He also said, if we can turn to the Fed, that he cannot wait for the termination of Jay Powell. Brian, do you read this as he's waiting for the Fed chair's term to be up next year, or does he plan to oust Jay Powell?
I think he probably waits a year. I think the chaos and the undercutting of Fed credibility it would be so severe that it would damage the administration's longer-term goals by ousting him early. That's credibility with investors that they'll never get back. Look, I get the president's frustration. The sense of frustration that he explains in public, but I think he will wait. There's really nothing to be gained by prematurely trying to get out the Fed chairman.
Brian, how much damage is being done just by the suggestion? It seems like there are a number of sacred cows in markets, and Fed independence is one of them. And when you start questioning that sacred cow and maybe putting it up on the chopping block, suddenly people get really nervous fundamentally about policy uncertainty in the United States. Has that already been accomplished?
You know, Lisa, I was listening to your previous segment with Brian Levitt, and there was a lot of conversation about uncertainty versus certainty. And I would argue that we actually have a more of a degree of clarity than we thought at the beginning of the year. Linking this to the tariff agenda, it is clear, Jonathan alluded to this, that there is clearly a move to restructure the entire U.S. economy and U.S. politics, the way we look at policy. So, I think that investors in totality are coming to the conclusion that this administration is moving in very, very different ways. And, you know, specifically on your point on the Fed, once you start opening the Pandora's box and you start talking about the possibility of removing a Fed chairman, and let's be honest, this is not done in a vacuum, right? He's already fired a couple of board members from other commissions throughout the government. And the legal argument, the philosophical argument would be, well, if he can replace them, then he can replace the Fed chairman. I just think that the cost of doing so is so high that I think there are voices in the administration that can talk him out of it. But if it was left to his own devices, I think the chances are higher that Trump would fire Powell than I kind of previously alluded to. I think he will ultimately be talked out about it, from it, but I do think it's certainly something that he considers.
Brian, there's a lot to unpack there. You talk about how we do have some certainty about what John was talking about, which is rearranging the whole structure of the global trade order and how the U.S. is viewed in international trade structure, which has massive implications for the dollar, for treasury yields, and for a host of other U.S. dollar-denominated assets. The lack of clarity here, I think, remains in how much of a check markets are, and I'm talking about both bonds and stocks at a time when some of the major CEOs from retailers are meeting with President Trump. Do you have a sense of how much this president is responsive to turmoil in markets and, frankly, a hit to the bottom line for a lot of these companies in the near term, which is inevitable if you restructure things in the way that we're talking about?
So the pause tells us that there is some sense within the White House, within the Oval Office, that they have to that the administration has to pay attention to markets, and they will respond to markets. At the same time, this president is in a second term. He's not going to be running again, jokes aside, for a third term. A lot of this is about legacy, and we're dealing with issues that he has been talking about going back to the 1980s. So yes, markets are a check to a point, but I think he is, to use the cliche, he is playing the longer game. I think he is looking longer term at his legacy. And so when we're talking about these restructuring, there are people in the White House who see financial markets as throwing occasional temper tantrums that will subside, and the markets will get back to normal, and equity markets will recover, and the bond market as well. But I think they are playing a longer game when we think about all these policy changes.
Brian, I appreciate your take this morning. Thank you, sir. Brian Gardner there of Stifel. We can handle growth scares. We've done that a million times. This is not your average growth scare. This is not just a shock to the cycle. It's a shock to the system, and it's going to take a while to internalize that. And we've talked about that repeatedly on this program over the last month.
I was speaking to someone yesterday close to the Trump administration who said, you know, Emery, stocks go up, stocks go down. And they are thinking about this long-term realignment. He is playing what they would say a bigger, longer game. But what is interesting there are voices who are looking at the markets. Obviously, Scott Bessent. After Liberation Day, he came out and he said, no, I'm not part of the negotiations. I asked him about that recently, and he said, no, I meant I wasn't part of the tariff charts. There is a pushback, especially when it comes to the bond market.
Equities right now, equity futures positive by 0.9%, and just a little bit of stability in the bond market following yesterday's sell-off on the long bond. Up next, we'll catch up with Robert Sockin of Citi, cutting expectations for global growth. Live from New York, you're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bouncing back this morning, equity futures up by 0.9%, down on the month through yesterday's close by around 8 percentage points. The worst month potentially going back to 2022. On the Nasdaq up by 0.9%. On the Russell up by 1 percentage point. 3 hours away from the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. U.S. solar stocks off like a rocket this morning. First Solar, that's the one I picked up, 6.7%. The Trump administration putting as high as 3,500% tariffs on Southeast Asian nations on their solar exports after a year-long study that was first commissioned by the Biden administration saying that they were selling into the American market at a lower cost of production. So those tariffs go on. The U.S. solar manufacturers benefit. Amazon also rebounding this morning, but this could be due to the fact that it fell more than 3% yesterday and that tech in general fell back into a bear market, at least as judged by the NASDAQ 100. But still a story to keep your eye on. Wells Fargo analysts saying that AWS has been pulling back on their data center leases, something that might look similar to what Microsoft did in the warnings of Alibaba, of Joe Tsai over there. AWS VP, though global head of data center, says that it's more about the day in and day out flow of AWS, and it still has very high demand. Finally, wrapping things up with some sell side action. Loop analysts upgraded Norwegian Cruise Lines. Those shares up 1.5%. Their target now implies a 50% increase from here. A fascinating reason why they say cruises are a recession play because they're about 30% cheaper than land vacation. So they say buy this if we are indeed heading towards an economic downturn. John.
I'd rather stay at home. Danny, thank you. Danny, thank you very much. More from Danny later on this morning. Less about cruises. On our radar this morning, President Trump ramping up pressure on Fed Chair Jay Powell, warning the economy may slow unless, quote, Mr. Too Late cuts interest rates. Trump adding that there is, quote, virtually no inflation, pointing to lower energy and food prices.
There are a couple of questions here. Number one, how feasible would it be for him to get rid of Jay Powell and then prevent the FOMC from electing him chair again as just a member of the Federal Reserve? So there's some technical questions. There's also the issue of the other Fed members that do have votes, that he could potentially have to fire all of them, but that might be a bit of a stretch even for him. And then there's this question, and this was raised by RBC, which I thought was fascinating. It gets rid of a good scapegoat. Mr. Too Late, you take him out of the equation. Who does President Trump blame for some of the market turmoil that we've seen?
Blake Gwynn also makes the point in this note about this idea of the scapegoat, and then you're left with potentially a new Fed chair that you put in place. You're not going to want to scapegoat that individual. They said keeping Powell around and continually pestering him on social media makes it much easier to muddy the waters, and also, Jonathan, pull the narrative away from tariffs, which is causing a tremendous amount of uncertainty for the business community.
And also, as people have said repeatedly, what about the rest of the committee? You fire the Fed chair. What do you think everyone else on the FOMC is going to do in response to that?
Right, which is the reason why, essentially, it might be a bridge too far to fire all of them, because even for him, that might seem a little bit like, a little excessive.
This is only one policy you need to keep an eye on. The other one, of course, is trade. The White House saying the US and India have made, quote, significant progress towards a trade deal. This coming after a new round of talks in New Delhi between the Vice President, J.D. Vance, and the Indian Prime Minister, Narendra Modi.
So I think this is a really important trade discussion. We learned a lot from the readouts. One, the U.S. U.S., part of that White House readout said that the sides have finalized a roadmap for a possible deal to reduce tariff burdens. So potentially, if you cannot strike a trade deal in the 90 days, potentially you'll be reprieved. India, in this case, 26% reciprocal tariff rate, now down to only 10. You'll maybe get that reprieve if that minimum, there is a roadmap that negotiators could then get to for the end. Second, so they're willing to get to the fall for this. Second, what I also thought was interesting is that we did learn that India is obviously going to be one of these key priorities. And Narendra Modi went to the White House back in February. So I think individuals who made a point to make the U.S. a priority immediately after Trump's inauguration are going to be first to come for a trade deal.
The rhetoric has calmed down recently, but some of the language around allies and trade partners has been pretty brutal over the past few months. Shout out to Peter Schiff, Academy, who's made the point repeatedly that the American brand could be damaged abroad. And I think that's going to come into focus a little bit later on as well, with Tesla offering their report on first quarter earnings after the closing bell. Concerns rising after the car maker released weaker than expected first quarter sales. And you've got this backlash against Elon Musk happening simultaneously, Lisa. All things to think about going into the closing bell in this earnings report later on this afternoon.
I wonder if this is a reason we haven't been hearing a lot about Doge or Elon Musk recently. Seriously, it's a time when you're hearing about Code Red from Dan Ives, about the potential for him to get back in his seat as the head of Tesla. To your point about the damage to the American brand, quarterly sales of Tesla have fallen 41% in France, 55% in Sweden, 55% in Denmark, 49% in the Netherlands, and now Tesla's coming out with this discounted mechanism of lending to try to sell Teslas over in China. They are in Operation Play Defense and try to double down at a time where they are delaying their release of their lower cost vehicle in the U.S. It is a key moment to see how much this brand, which has become emblematic of the Trump administration, backtracks and tries to create some distance.
Tesla this morning, positive by about 0.7%. Earnings in focus, this from 3M just moments ago, seeing 2025 adjusted EPS tariff sensitivity of 20 cents per share to 40 cents per share. That's a new phrase for you. Tariff sensitivity.
I was about to say, tariff sensitivity. Please define what tariff sensitivity is and how you calculate 20 cents a share to 40 cents a share. And you're talking about this within the range of a full year adjusted EPS expectation for continued operations of $7.60 to $7.90. It's actually not as big of a range as you've seen from some other places. So how do they quantify this? Are they putting a task force on it?
I think they probably are. I think it's fair to say we're in uncharted territory for earnings in corporate America at the moment. The President of the United States expressing optimism as the administration looks to strike new trade deals. Robert Socken of Citi marking down growth expectations, writing, quote, "We see global growth falling from just under 3% last year to 2.1% in 2025, as our forecasts have been marked down for a broad group of economies, including the United States." Rob joins us now for more. Rob, good morning.
Good morning.
2.1%. That's global.
Into that territory, it would be a distinctly weak year, much weaker than we saw over the last few years when we grew just a bit below global trend, but still probably would skirt that definition of global recession. But that being said, I think the risks to the forecast are skewed strongly to the downside, especially because within that forecast, we still have China growing at a decent rate despite this trade war going on between the U.S. and China, and we don't have a U.S. recession in the forecast. We have low growth but no recession. If those two downside risks materialize, you could easily get into global recession territory.
Just sit on China for a beat. What's driving that growth?
Well, it's interesting. If you go back not too long ago, we were actually marking up growth in China. We were marking up growth in Europe. These narratives were getting more positive. In China, we were starting to see signs that private sector demand was picking up. You had the positive AI story that was developing and the investments around that. But this trade war has kind of reversed that narrative, and the headwinds are going to be substantial. We do see the government coming out with more stimulus to try and offset some of that, which is why that forecast is not even lower on the year. But, you know, it's going to be a big challenge if this trade war persists.
How much can there be a huge divergence between the rest of the world and the United States, where the rest of the world actually takes off and starts expanding at a faster rate, especially based on the fact that rates can keep going lower? You might get disinflationary forces in certain places, and you have the potential for stimulus at the same time that money is flowing into their economies and away from the United States. I mean, it's a pretty potentially rosy scenario for outside of the United States to diverge.
Yeah, absolutely. And if you look at the contours of our forecast, you get a lot of softness in the U.S. You get softness elsewhere, and it depends on how these tariff negotiations and tariff uncertainty evolves. But other parts of the world hold up relatively well. Outside of China, most of the EMs, we've been marking some of them down slowly, but most of them still have pretty solid growth forecasts. But I do think that the policy uncertainty and the tariffs that are emanating from the U.S. is going to weigh on a lot of economies. I mean, for Europe's a good example. We had 1% growth over the next 4 quarters prior to these tariff stresses. Now we have close to 0 growth or just above that. So I think for the rest of the world, it's going to be hard to grow or at a solid rate, given that these tariffs are still looming large and trade uncertainty is still looming large.
How much would you have to see to get more constructive on the global outlook, where suddenly a weaker dollar actually helps support U.S. companies? You end up with a little bit more in terms of certainty with trade deals, and suddenly all of this sort of negativity reverses course. The hard data has been solid, and things are looking a little bit more like they were maybe 3 months ago.
Yeah, absolutely. And I think we're in that 90-day pause. And if we start to get trade deals materializing over that period, and there starts to be signs that the administration is backing off of its tougher stance on tariffs, not backing off entirely. We do think those trade deals are going to have probably a 10% minimum tariff. Those sectoral tariffs will stay in place. But if you start to see us moving away from that very high level of uncertainty, where we don't know what the tariff's going to look like in a week or 2 weeks, and you start to get those deals emerging, I think the global economy is still going to have a tough patch for the next few quarters. But, I could see that forecast for the global economy that's at 2.1 moving up a bit if that uncertainty starts coming off the boil. But right now, I think the risks, again, are still skewed to the downside, especially because more tariffs are probably likely to be announced in coming weeks, and we don't know how these negotiations are going to go.
And these negotiations are for trading partners, not China, where America gets most of its goods. How long can you wait around and not have a trade deal with China?
Yeah, and I think that's the challenging situation, is that this trade war feels untenable from both sides. You're looking at tariffs on many goods that go across both borders of well over 100%. That trade is going to be uneconomical. So if you keep those tariffs on, trade in those categories is basically going to fall to 0 over time. And we still get, in a direct sense, that's not even including indirect trade through other countries, over 13% of our imports from China. So it's a big headwind. I think we're probably going to see the temperature cool down there as well. But the longer that persists, the deeper the risks are. Especially one risk in that conversation is what happens with global supply chains. Like, are we going to get shortages and stresses like we saw during the pandemic, given that China is still deeply entwined in global supply chains?
Can China still grow if other countries put their walls up?
Well, that's going to be another tough conversation, is if this trade war persists, are other countries going to put on tariffs on China to kind of gain favor with the U.S.? And we're going to have the world kind of breaking up into spheres. Again, I hope we don't go down that route. But China, I think, will be okay for the near term because they have enough policy stimulus space. They have a lot of connectivities with other economies. But if we're in a persistent deep trade war, it's going to weigh significantly on their economy over the medium term.
From the perspective of price stability, the Europeans might have to. Have you seen a chart of Euro CNY? Euro CNY has gone from 740 to 840 since the start of February. They're going to have to eat a lot of Chinese exports. Isn't that the biggest threat to price stability on the continent right now?
It's a big challenge because these exports have to go somewhere. And again, 13% of U.S. imports, that's a lot of goods. Some of that we think is going to be rerouted through other economies, as we were talking about, that eventually go to the U.S. But if the administration cracks down on that, that cuts off an important channel for those products. And a natural point for where those could go is Europe. But I think if that starts to happen, you again have a conversation, well, do the Europeans start to put on trade barriers of their own to kind of protect their own domestic industries? So this could get even messier really quick, which is saying a lot given how messy it's been over the last few weeks.
Just to sit on Europe, do you think they'll have to? That economy at the moment's at stall speed. I know a lot of people are excited about a prospect of fiscal stimulus, but we were already talking about 0% growth on the continent. What's this going to do to them? Disinflationary price action at the time where we have 0% growth on the continent.
Yeah, exactly. And that's the real challenge. And I think in the near term, they have other challenges to face as well, primarily also negotiating with the U.S. And I think that puts them in a very difficult spot, which is another reason that I think other countries are going to be putting pressure on the U.S. and on China to kind of come to the table and make some sort of deal. Because as you said, this is going to be another challenge for Europe that is going to be difficult to handle. Actually, in an environment where, again, if you go back a few months ago, you were finally starting to get a positive narrative emerge out of Europe for the first time in several years. Unfortunately, that's largely gone away with the current trade stresses. That could come back if these trade stresses move away, but I think, again, at a minimum, they're going to be facing challenges from both sides, from the US and China.
Huge changes in the past few months. Rob, it's good to see you. Thank you, sir. Robert Socket there of Citi. Equity futures doing better, positive by around 1% on the S&P. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump's tariffs are starting to hit some Japanese firms. About 10% of more than 500 firms surveyed by the Ministry of Finance say levies have affected their business. CEO of Japanese beverage giant Suntory Holdings says tariffs could make companies reluctant to invest in the U.S. A Republican proposal to tax income of over $1 million at a 40% rate could generate about $400 billion over a decade. That, according to research at Yale University. The revenue could offset the cost of the party's tax package and fund new tax breaks like eliminating taxes on tips or increasing the child tax credit. And a check on Novo Nordisk shares falling more than 7.5% in the European trade. Strong data from Eli Lilly's rival obesity pill sparked fear that it will take market share from Ozempic. Novo filed for approval for a high-dose pill with the same active ingredients as Ozempic, but analysts expect Lilly's drug to have a better profile. And that's your brief, John.
Thank you, Danny. Thank you very much. More from Danny later on this hour. Up next on the program, U.S. exceptionalism at risk.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders. The end result is that we're all asking huge, major tectonic shift questions.
Up next on the program, Krishna Goa of Evercore, live from New York City. You're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up
up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Live from New York City this morning. Good morning to you all. Equities recovering, up by 1% on the S&P. On the Nasdaq 100, up by 1 percentage point. Also, under surveillance this morning, U.S. exceptionalism at risk.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders that have been so powerful for U.S. companies and being able to benefit from falling interest rates, from the ability to benefit from rising margins over time. And so the end result is that we're all asking huge, major tectonic shift questions.
So here's the latest this morning. Investors looking for safe havens outside of U.S. assets, with gold hitting fresh record highs. Krishna Gua of Evercore writing, we think any effort to remove Powell would lead to a surge in stagflation trades, further curve steepening, dollar sharply lower, and a much larger increase in the risk premium on U.S. assets. I'm pleased to say that Krishna is back with us on a program for more. Krishna, welcome back to the program, sir, and good morning. You wrote about it going into the weekend last week. You said that if you love the trade off the back of the trade debacle, then you'll love the Fed independence trade, the loss of Fed independence. Can you talk to us about that, Krishna? Did we get a flavor for it in yesterday's session?
So I think we did get a little foretaste yesterday of what kind of a train wreck it would be in markets if the president ever decided to actually try to fire Fed Chair Powell. Now, to be very clear, I continue to think that it is not likely, it's not 50% or higher probability that Trump will actually try to terminate Powell, but it's clearly a non-trivial risk, a serious risk. And when it's put before markets, you get the verdict that you got yesterday. Yields higher, dollar lower, stocks lower, fundamentally reduced attractiveness of U.S. assets across the board. And that is, I think, a cautionary message, and I hope it's being heard in the right places. Remember that up to this point, what we've seen in markets is a clear sign of erosion of confidence in U.S. administration economic policy making, but we have not seen a loss of confidence in the Fed. We can prove that because up to this point, the inflation break-evens have stayed very well behaved. The market has not priced in stagflation trades. But if you ever got to the point where Fed independence was actually being